I'm still young, right?
How are you, Luke Moore? We haven't seen you for a week.
It's Wednesday.
Yeah.
Wednesday last week to Tuesday. You had me for a bumper session last Wednesday as well. Things are good. Things are good. I mean, the markets aren't, but I'm okay. I've survived so far.
Any good stories for us?
No, I spent the weekend eating, as you so kindly called me out.
Oh dear, we've had a problem on audio, but we are live now. So we'll start again, shall we?
Shall we? Okay.
It is Tuesday the 4th of March. Welcome to Trade Live with IG. Well, let's hear the round of applause again. They didn't hear it the first time. Gavin Acker's up in Edinburgh. Welcome to you, sir. Great to have you. Send us a picture. Drop us an email at ask@ig.com. I want to see that sunrise in Edinburgh. And Boise, that is really useful. What you've said there, it's interesting to discuss how to trade differently in a down market. That's exactly what we're going to do today, because it feels like it's time to sell the rallies rather than buy the dip. And that definitely changes the way you think. The perfect example is Bitcoin.
Yeah.
Bitcoin losing all of that.
All of the, can we call it a pump and dump from Trump? A pump, dump, and Trump?
A Trump and dump.
A Trump and dump.
It is a Trump and dump. That is how it's now known. We're now lower than we were when he sent the text to enrich his friends.
Yeah, I think you call that exit liquidity. That's what that's called. Yeah, quite incredible, really, as a turnaround. It was. I remember seeing it. I was in Tesco's. I was actually waiting outside Tesco's on Sunday afternoon when I saw the text come through. I'm just thinking, okay, right. He didn't mention BTC the first time round. That's inevitable. Then he mentions it because all of his mates gave him a heads up that they didn't mention it.
Yes.
and then, yeah, it just got absolutely slamboed on yesterday. It's quite incredible, really. I mean, everything got slammed yesterday. So it was just a broad, I hate that term, broad risk off.
Yeah.
But it was exactly that. It's sell first, think later. That's the kind of the market where we are now. And as I was saying before, the guys switched our audio on. Nothing good happens under the 200-day moving average. Nothing good. And so we're now there on Nvidia. So yesterday's almost 9% drawdown on Nvidia sticks us firmly.
300 billion wiped off the market cap.
Yeah, but that's a. I agree it's a real number, but I disagree with how important it is. It's the biggest stock in the world. It moved by a big number. Yes, there's a lot of money moving hands, but that's what happens when markets get big,
And when stocks are overowned.
Well, yeah, stocks are definitely overowned. It's something like 40 to 50% now of all US households have stocks in the have positions in the S&P.
Yeah.
So
it's the concentration that's the problem, isn't it? In Nvidia, obviously, everybody's got some, including myself.
Yeah.
And yeah, you can't sell something you don't own.
Technically, you can via puts, but
well, in a risk-off environment, you don't take risk off by adding new positions.
No.
So, shall we have a look at what's coming up on today's show, Mr. Moore?
Let's do it. So. 8:40 a.m. trade expectations. Matt Arber's going to be bringing you through. Staying through till the US pre-market open.
That's right. I'll do the US all sessions open.
Perfect.
At 9.
And then at 9:20, Tom Wolstenholme will be giving you a trader tools.
And do you hear the story that we've tracked down his namesake?
No.
So Tom Wolstenholme has two personas. One of them works here. And one of them works and is part of our chat and works with another one of our clients who was at the rugby last week.
Oh, really?
So there's only a one-letter difference in the spelling of their name. But we want Tom to come in and do Tom's takeover.
Tom's
takeover.
It
literally will be Tom's takeover.
Tom's working from home and Tom's working from the office.
Yeah, which one's working from home today?
Yeah, exactly.
Good stuff. Right, let's go into overnight action then and see what happened in that bloodbath yesterday. Right, what do you want to look at first? Shall we look at the S&P 500 and then go over?
I mean, you can look
it happened.
You can look at pretty much any US index. We're going to call this section Tariff Tuesdays because that's what we've got. Tariffs have kicked into gear overnight, so we've now got 25% tariffs on Mexican and Canadian goods. I think a lot of them, the reason why we had this sell-off yesterday was the additional 10% tariff that we are now going to see, or the US are imposing on Chinese imports, which was double, of course, from the 10% that was announced previously. And what did you get? Everything came off.
Yeah.
Everything came off. The S&P was down 2%, NASDAQ down 2.6.
There was a little bit of a clue before that. There's, you can see that I went short at 4:20, and that's because I got the message about this GDP now. So if you remember last week, we were talking about this GDP figure that gave you an indication of up to the date forecasts of how things were tracking. Well, it was down 1.5% as of last week, and people were thinking, oh, I mentioned yesterday it's a technical thing, you know, but it doesn't matter how technical this is to do with tariffs. It is happening, and the Atlanta Fed came out yesterday, they updated their figure, and it's now down 2.8% for US GDP. So that set the cat amongst the pigeons. That's why I instantly knocked out those futures, because I knew that I was going to have to protect, and the risk of Trump adding tariffs on top of that, which is what's causing it, that's a real...
I've got a theory on this. It's all the art of the deal. This is all supposed to have happened, is my theory.
Right.
GDP crashing, GDP now crashing, means that the Fed are going to be forced to cut rates because of the impending recessionary fears that it brings.
Yeah.
And if that happens, you've got probably an amount of time where, well, right now you've got the threat of tariffs. The tariffs have been building up, they've been coming. So anybody that is importing goods from outside the US has probably had to stockpile on these goods.
Oh, huge, yeah. That's
so all these automotive companies, all these agricultural companies have just been saying, right, what the hell is going on? We don't know.
Yeah.
You know, we have to stockpile because we don't know whether everything that we're buying is going to cost us 10, 15, 20% more. So they're buying loads now. GDP's crashing as a result of all these imports, because more imports, GDP comes down because the exports.
So the money flows out of the country, yeah.
Correct. GDP comes down. Everybody's got to start to now sell down this inventory. Rates come down. Trump backs off. Back to normal. Trump gets what he wants. He said during the campaign trail that he wants rates down. He can't bully the Fed, but what he can do is he can bully everybody else to then make the Fed fall in line.
I'd love to think that he's that far advanced, but he's adding inflation. So this, you know, the swingometer of worry yes, it's moved to jobs now, it's moved to growth now, and so we're getting a third rate cut priced in. You can see there on the rates that I put up, 3.95 on the 2-year, 3.95, absolutely incredible. On the 10-year, 4.17. So that's the longest yields we've been seeing for a while. And if we go to, now what's the web page with the
FedWatch.
Testing my memory at this time in the morning.
Yeah, so we're now getting 3/4 point rate hikes, which is up from just 2 days ago. There you go. So if you go to probabilities on the left-hand side.
We'll take out to June, shall we? Probabilities.
Yeah, and then if you zoom in on this boy, what this is showing you is the meeting dates on the left-hand side, and then what are the chances of those ranges across the top are the rate ranges. So if you'll see at the moment, the meeting that we've got in just over 2 weeks' time, yeah, almost bang on 2 weeks, there's a 91% chance it's between 4.25 and 4.50. Okay, so that's only a 10% chance that there's going to be a cut. Then it drops to 60% in May, but then all of a sudden you've got a 53% chance you've now got one cut, 40% chance you've got 2 cuts, and then it kind of drops down and you're looking at, you know, supposedly now 3 cuts before the end of the year. This is what he wants. So yes, there's a threat to growth, but by cutting rates, this is what he wants. I just struggled to see that this isn't planned. You know, we both said that Friday's ambush to Zelensky was clearly planned.
Yeah.
You know, when Zelensky gets out of the car, he's like, "Oh, you're not even wearing a suit. Cool, thanks." Like it was entirely planned. And now
the plan goes on apparently. So my sources in Westminster tell me that Zelensky will be back in 2 weeks and he will sign the deal.
Well, I think he was ready to sign the deal. It wasn't him that got kicked. It wasn't him that Trump booted him out. It wasn't him.
And literally, so the whole Ukrainian delegates were taken into the room where normally you go into in the White House as you entry.
Yeah.
This is not an exit room.
Yeah.
They were all piled in, and they were made to wait a long time. And they said, "Okay, we're ready to sign the deal. When do we sign the deal?" No, you're leaving. Literally thrown out. But I am told he will be back in 2 weeks and to sign it.
Yeah, look, I think, again, I'm trying to think big picture all this stuff, because I think it's worth taking a step back whenever you see moves that we've seen in the last couple of days, and everybody's portfolios are probably hurting a little bit. It's worth taking stock.
Yeah.
Trump knew that his next stop on this tour was London. I don't doubt that was
and with the hugs of Europe.
Correct. Yeah. So now what he's been able to do is he's been able to get Europe to come together through threatening them effectively. We will back away from NATO, and that still may happen, but by threatening them to back away from NATO, they now have to get themselves in a line. Starmer looks to be the hero, because he was the one that's pulled everyone together. It's in his backyard, it's in his house.
Yeah.
So politically,
which Trump's given him.
Yeah, correct. But they planned that again the week before.
Exactly.
I just don't think any of these things are circumstantial. Are not circumstantial.
Yeah.
I just think it's part of the picture. So the markets are reacting to it as they probably should, because it is something to react.
However, what he cannot control consumer behavior on the masses.
No.
Right? And therefore, you really risk inflation. And we've talked about it on here many a time. You risk it from higher tariffs on imports. So those prices go up. You risk it on immigration, because your labor force is depleted. So we're actually going to get a slowdown in growth, but that's not the Fed's mandate. The Fed's mandate is unemployment and inflation, right? Now, unemployment, because you've got a mass exit from the labor force, unemployment is still going to stay low. So growth, that is the measure of growth. So it doesn't matter what GDP is, that's not the Fed's mandate. Therefore, you cannot cut rates when you've got full employment and you've got inflation going higher from wage growth.
But what you can't then calculate is the drop in demand.
Yeah.
That's the balancing act, because if you get a drop in demand, supply will then outstrip demand, therefore deflation has to happen. It's economics. Morgan Stanley have come out overnight saying that they think that with 25% on Mexico, Canada, and 10% on China, so that's now 20% on China, so these numbers are going to be out of date. Yeah, they reckon it could reduce S&P earnings by between 5 and 7%. So that's material, especially when you've got the S&P.
24 times earnings.
Well, it's trading 22 times earnings now.
Well, no, but that's the wrong earnings number. So take that 5 off.
Oh, sorry, yeah, it will be, yeah. So that, it's currently, it was valued at 22 on Friday, so you strip out those earnings, then it's going to be lower.
No, but that's what I'm saying is that the expectations are for a 13% increase this year. So that it's trading on 22 times 13% higher than last year.
Oh, so you now only...
and now we're talking about
7%.
Get rid of the expectations for higher. We're talking about lower GDP.
Yeah.
And that is the answer. That is exactly why you're seeing the S&P trade 58.50. Because if this rings true, then we're on the wrong multiple and we're on the wrong earnings number. And you forget the AI story at that point. You've got real problems. Then you've got Elon, right? And whatever way you look at it, it's austerity, right? Steve Cohen said it last week. I think it was in Florida. And Steve Cohen, right, 25% a year for 25 years. Some of it was questionable, but he's still, he's had the returns. When he turns around and says that he's starting to get worried about the market, then you really take note.
Yeah. The difficult thing is it's difficult to know how much of this is posturing for the art of the deal versus how much of this is going to be a prolonged period of trade war. Because I was trying to remember on the way in this morning, Trump 1.0 had his trade spat with China, And that went on for quite a long time. You know, that was months and months and months and months. In fact, I'm not even sure they agreed a deal while he was in office.
It was very frustrating trying to trade the mining stocks while that was going on.
God, I remember it was frustrating reading the same flipping headlines every day. You know, Trump says this about China, China says this about Trump. And it was just this flip-flopping of headlines.
Yeah.
And it was really difficult for clients to know which way to view it. So, yeah, look, I mean, what are we seeing? What did I see clients do yesterday? Massively deleverage.
Right.
So we saw people come out of their positions.
Which is the right thing.
Which is definitely the right thing. So to Boise's question, you know, should you be reducing size? Yes. Our podcast tomorrow is going to be all about this. It's all about using volatility or using something like a risk metric.
That's exactly what I was getting at.
Yeah, use an average true range. Use the VIX as a way to gauge this. So yeah, there's definitely been a deleveraging. You know, yen, gold, Swiss franc, the classic safe havens have been bid up. We know that. Gold, you know, it's come off its highs, but it's still sitting pretty much at 2,900.
Yeah.
I think the volatility is just going to be here to stay. I think it's going to be here to stay because we've now got the VIX above 20, which is the highest it's been in 11 weeks. So you're right. You know, you said at the top of the show, Nvidia's moved by what number?
It was down 300 billion yesterday, but from pre-market, that's 20% from pre-numbers now.
Yeah, which is a huge number.
700 billion.
But we're going to have to get used to this. You know, unless the VIX comes crashing down through some form of resolution, these massive numbers are going to stick around. So as traders, we're going to have to reduce our risk because 300-point moves, you know, the DAX, look at the DAX now. The DAX is down 200 points already this morning.
Yeah. So this is my cutoff. Now to go back into it, why do we look at the VIX as that measure of fear, right? So my cutoff is around 24. It used to be 24, but the average range of volatility has come down. So I might even go down to 22 now as a real kind of risk warning. And we can come off that. Thanks, Caleb. So the reason, of course, that you see a spike in the VIX and you see the sell-off leads to more pain is because when that's happening, it means the market's coming off. It means that people's favorite positions are the ones that are going down, and the ones that are short are going up. So you don't have, let's say you're a hedge fund manager running 100 million, right? You don't have at that point 50 million of longs and 50 millions of shorts, because that normally means that you're balanced.
You're delta neutral.
You're delta neutral, and your market risk is fairly low. And all you're trying to do is get the alpha, one beating the other. When in this market, when the VIX goes above previously 25, it might be 22 now. When it goes above that, you've got 100 million of risk because your longs are coming down and your shorts are going up. Therefore, you're losing on both sides. That's when you get stopped out. The risk manager taps you on the shoulder and says, you're done.
You're done. You've had enough.
And when we've got the pod systems at Millennium, and the other pods, that they've got very, very tight risk metrics now. You lose 3% and your book's done. Positions get cut. When positions get cut, we know what happens, Luke, don't we?
Well, how long do they? So 3% is an interesting rule because that's exactly what Axel says you shouldn't put in terms of more risk. Or you can have multiple positions, but you should never have more than 3% of your account at risk.
Yeah.
So is that 3% risk? You're stopped out. You're done for the day, week, month. What do they say?
No, so it's your whole portfolio. If your portfolio drops by 3%, then you're cut. Yeah.
Right. Okay.
And it's the same. Look, this always happens into weekends, especially. Right? There's this. Banks will take a hit on a Wednesday and a Thursday, but by the time they've had the conversation on a Thursday night and they see the P&L and the hedge funds see the P&L, the risk manager takes control on the Friday.
It says you can't trade.
And says, you're out, get your book off. And when you're told get your book off, again, you're selling your best positions. Yeah. You're buying back the worst stocks out there.
Yeah.
So just be really careful. We're all logical traders, so you want to buy the best stocks like Nvidia and Palantir and all the favorites, right? You want to buy those, but don't buy them when the whole world is selling them.
Not yet.
Not yet. Oh, when
it's
you'll
kind of-
see the shank out, and the VIX will be at 32, and then you start. You just for the next few days write your shopping list,
Right.
and be ready.
Yeah. I tell you one thing that is interesting. Have you noticed how the sell-offs are only during the cash market hours?
Yeah, it's really quiet.
It's quite weird, right?
Well, the CTAs, yeah, that's because
And that's what I think is happening. I think there's a couple of things that are going on. I think the fact that, is it 30 to 40% of all options flow is now dealt on 0 days?
Yeah.
I do think there's an element of dealing desks that are taking on, risk as a result of these 0 day to expiries have to trade. So if you've all of a sudden, you've written a load of puts, you have to trade against those in order to hedge your risk. Now, as that market continues to go down, you have to continue to sell more, and it becomes this self-fulfilling prophecy.
Yeah.
And I do worry that, as we see more and more volatility on these shorter dated options, it has its ramifications in the stock market because they don't.
Yeah, but this I wouldn't. This is real selling though. What it might be is the CTAs, because the CTAs have been long, and these are the commodity trading algorithms, and this is your black boxes that have they're long at any time 50 to 100 billion of equities globally, and once they trigger a certain level,
They have to go.
they have to. There's no fund manager. It's an automatic.
What sets those levels? Why?
I mean, that's when technicals actually come into play. So
I've seen some analysis like this before, where it's on an up tape, X amount of buying has to happen. On a down tape, X amount of selling has to happen. On a flat tape, X amount of buying has to happen. Something like that.
Exactly.
And I've never quite understood why that is the case.
Oh, because that's just the algorithm that it's set on. All the calculations is saying, right, if you get to the 200-day moving average,
Dump it.
then you go from being 20% long to flat, and then if it goes down more, then they want to go net short. So they're just massive traders, and they
momentum, right?
And they
Just
work
big
off this
momentum
momentum, huge. So if momentum's getting screwed, then these guys lose a lot. But in normal times, over the last few years, they've made incredible amount of returns.
Well, of course they have. Look, I think that's going to be the story that we're going to have to...
Okay, here we go. So CTA positioning. They have delevered in the US and Japan, but they remain long in Europe and China. They've trimmed exposure in energy and agriculture while staying short oil and long metals. So it works, doesn't it?
Yeah.
They're long dollars. That one's not working so well.
Not working.
Expected positioning shift. If prices rise, CTAs may sell MSCI, EM. They'll sell the VIX. They'll sell South Africa.
So emerging markets, VIX. Well, the VIX would be a dangerous thing to sell at the moment.
Yeah.
Just because it's continued that, if that momentum continues, if we don't get talks around peace, if we don't get talks around these trade discussions coming back, then that's a painful one.
Yeah. So that was the weekly update from Goldman's on, it must have come out yesterday. So, yeah, interesting stuff, but it just shows you how much goes into these kind of moves, and it can be dangerous to step in front of. Now, I know that because I topped up on my NVIDIA yesterday, and that was painful, but I am short a lot of NASDAQ and S&P against it.
Nice. Well, I did the same. I topped up my SMT yesterday morning. I thought I'll buy the dip in this tech market and not do. Yeah, I just went too early, clearly.
And even Tesla, slide off, thanks guys. So even Tesla, I was tempted because Adam Jonas put it back into one of his top performer lists yesterday.
Oh yeah.
So that's the analyst at Morgan Stanley. That's probably the number one autos analyst in the market, and Tesla's a top pick. Should we go to a really quick 2-minute break?
And let's do it, and then we need to go through some UK equities because there's quite a lot that's come out as well.
That's right. So we're going to talk about which company has found all its vowels. Answers in the chat. We'll see you after the break.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the Close button next to the relevant trade.
Welcome back to the opening bell this morning, Tuesday the 4th of March, also known as Pancake Tuesday, also known as Tariff Tuesday. What doesn't sell pancakes, however, is Greggs.
Oh, very nicely done.
You can have it anytime. I'm here all week. So they have been a beat. Their full-year adjusted earnings per share has come out at 137, which was a beat of 134. Is that a Greggs wrapper?
It is. I did go for the bacon roll this morning.
Shocking.
Had a
Unbelievable. Their profit before tax up 9% to 203 million. They've made strong progress with their sales, record profits, like-for-like sales. So we like Greggs this morning. They are
Monkey Man, spot on. Let's go to the story there. Aberdeen drops its name amid return to profits growth. So it will now be known as the Aberdeen Group. It is no longer Aberdeen.
Do you know how much money they spent on that name rebranding?
Yeah, what?
Billions.
Really?
No,
not
stupid.
billions.
It was
Hundreds of millions.
Hundreds of millions.
And also, Luke Moore, stop going to Sainsbury's and getting your lunch deal because it makes you look desperate. Some people at Sainsbury's have actually included alcohol-free beer in their lunch menu, and that is not the right thing to do, according to the Etiquette Bible.
I mean, it's a ballsy move, isn't it?
It is.
It's a ballsy move coming back with a lucky saint at lunchtime. I don't know if, I mean, you can get away with it, I'm sure, but it's just a really ballsy move.
If you need somewhere to hide, The Times has an excellent article with Dame Emma Walmsley this morning. GSK has its momentum back. Is that the place to hide in volatile times? Chart off. Thank you, gents.
What we didn't mention there, even though we know that Aberdeen has now got its name back, their profit has been a small beat, 255 million. Their assets under management is bang in line with estimates, and they are confident of their outlook. ABRDN are being called.
Let's show you upgrades, downgrades, while Luke Moore is finding that for us.
Up 1.6%.
Up 1.6 in Aberdeen. HSBC upgraded by Barclays to overweight. Right, Hensoldt is a defence company you might not have heard about, but Auto say outperformed €69. We've got a buy rating on ABI InBev. There it is, Lloyds. Neil told you yesterday, away from the numbers, there is your Lloyds breakout, 90 pence. 90p. Upgrade overweight. BAE Systems downgraded. Auto should not be listened to in UK stocks. And Severfield. That's us. Right, let's go to UK. Opening bell, sir. Ring that thing.
I couldn't have to karate chop it because I haven't got anything. I'm so sorry.
Chopping
the magic of
a bell.
The magic of TV.
Right, we've seen oil come off. BP getting paid, having to pay for that oil going down. BP down 3.6%. Saudi Aramco cut their dividend this morning. So the oil sector is not happy about OPEC's decision to increase the Increased supply.
Increased supply, that was the one. They've got it the right way. BP have actually had a headline this morning. They've hired 2 top directors in a pivot back to oil and gas. So they are continuing their spin back to oil and gas.
Right, Whitbread down 2%. We told you yesterday the CEO was in the newspaper, in Times, making noises about increased costs. That didn't read too well. Burberry down 2%. Sainsbury's down 50 basis points. Do we have any risers, Luke Moore?
BAE Systems is continuing its strength, up 3%, trading 16.56. What else have we got up there?
Rolls-Royce, why is that not showing on the system yet? There it is, up 1.4. It's a bit of a Dreamliner move, that one. 787 trades. 787 trades on Rolls-Royce.
Yeah, you made that joke yesterday as well. I don't know if anyone laughed about it.
3.8%. Aberdeen, there you go. That's how much vowels are worth. Up 5%, being rewarded for turning their back on that ridiculous marketing.
Yeah.
No change on Greg's yet. Which way is it going to be, Luke Moore? Tell us how it's looking.
It is in the auction now down 5%. So
again,
let me have a look at this in a little bit more detail.
Oh dear, Carnival not having the best of days. Of course, that is. If you are down in Rio de Janeiro just now, you will be looking for a different Carnival. This one down 4%. Shell down 2.8. There's a story in the Times this morning about Shell as well. Potential small spin-off there. Scottish Mortgage Investment Trust, surprised it's not getting hit by more.
I paid £10.40 for that yesterday. Cheers. Greg's still not open. They've actually came out. So their like-for-like sales were up 7% in the first 9 weeks of 2025, but challenging weather conditions in January, followed by an improved trade in February. They've said they're confident on managing any inflationary headwinds and are confident on delivering another year of progress. But Winterflood said they're expecting to see some buyers at this level, but clearly not, down 5%.
Down 5%, that's Greg's. Diageo looking down 1. The mining stocks getting hit as well, down 2. With those tariffs going on to China, people starting to worry about Chinese growth, potentially cutting their inflation target from 3% to 2%. So that underlines the concerns there.
Ocado, have you seen them? They're also getting hit. They're down 2.7%. The Times has issued an avoid notice. They've said the outlook for demand is currently unclear. Get the F flipping out. 2.7%.
Even the mighty Vodafone, you know that a market is weak when Vodafone is even down on the day, still above the 70 pence mark, one of the best performers on the year. Marks and Spencer's down 70 basis points, BT as well. Producer Fred giving me the heads up that
Ashtead, they are down on numbers this morning. So their pre-tax profit missed estimates. They are expecting their full year results to be in line with previous expectations. However, and this is where I think it's going to be timely that they've announced this, they are unsure on their guidance for their Canadian business.
Oh, I bet.
Not surprised. So Ashtead are not sure on Canada and are getting killed for it, down 2.5%.
Okay, another place to park your money at the moment, it would be in Inchcape, up 5%. The auto showroom is doing really interesting things with its buyback. They're buying back around 9% of shares they've announced this morning.
Again, yeah, they're on numbers. So their full year revenues came in at 9.26 billion, which was in line with guidance. Operating profit came in a little bit light at 584 million. They've cut their semi-annual dividend by a third to 17.2 pence, but have announced a 250 million pound share buyback. So cut the annual divvy, announced a buyback, down 2.5%. Sorry, no, I'm looking wrong stock.
Right.
Inchcape
We'll be getting up 5% Inchcape there.
Now up 7%.
Right, Rheinmetall trading 11.65, back towards the highs of yesterday. We should have Greg's open.
Oh yeah, they're still indicating down 5%.
That's 5 past though. It should be
still not open.
Well, that would worry me if it's even worse than 5% then.
Well, no, the auction is indicating £19.74, which would be 5.19%.
There we go.
And it's opened at 19.74. There you go.
We're off and running in Greg's. Well, what a painful chart that is. Let's see where...
What's happened there?
Wow.
There you go. Changed it.
There we go.
Changed
So,
it up.
1984, the year Luke Moore was born,
You call that a
is
flat
your
bottom?
best bid.
Would you call that a flat bottom break? So you've got support at...
Well, that was a
figure?
Queen song.
Flat bottom break. Not quite. But that is a break of those lows where we tested at the start of the year. That is...
The sausage rolls are so good, Luke Moore. What is going on in this thing?
They are pretty good. They are pretty good. I'm going to say it's because winter floods left our building. Did you hear that story? I think I told you before, didn't I? I think there was the corporate broker and a market maker that used to work in the same building as us. The urban myth is that they were Greggs was put into a little unit outside the office to make sure that they could hit the Friday morning bacon roll run, but winds have moved on. And so IG, what that says to me is IG, you've got to do a bit more heavy lifting without bacon rolls and sausage roll purchases.
Big Kevin does his best, sausage roll every morning on the way in, our head of IT security. From St Andrews, an original member of St Andrews Golf Course. His family is one of the founders. So Aberdeen, now up 9.
Is that the chap that runs around in a kilt all the time?
No.
There's the guy on the edge of the dealing floor that runs around in a kilt, and I'm still trying to find out why.
Rolls-Royce up 1.3. We've got, right, what's happening in Europe? The European autos, especially Thales, is, we've had numbers from Thales and they are up 10%. There you go. That's why people are buying defense.
Can I get a defense?
So we're not just defensive on our portfolios right now, but we are also defensive in the only industry to be involved in.
Wow, look at that. That's trading like a crypto stock or a meme stock, or it's just incredible. Giving you the rundown of the numbers.
This is insane.
Their Q4 organic sales were up 13%, where the market was looking for 5%. So that's over a doubling on the expectation of their Q4 sales. Their full year sales came in, the percentage was up 13% on a 5, came in at 6.51 billion euros. The market was looking for 6. They're saying they've upgraded their full year sales between 21.7 and 21.9, which the market was looking for 21.6. So a decent set of numbers there.
But that's 2 gaps up in a row. I don't think I've ever seen a double gap on the open in two days running. That is absolutely remarkable. The stock is trading 246. Going into the weekend, it was trading at 190. It did 10% yesterday, and it's done another 10% this morning.
So okay, so play this out then. You take profit, right?
I'm thinking of shorting it. Never mind taking profit.
If you were long, you've got to take at least a third out, right? You've got to try and. This is a point where Axel would say, take a chunk of your position off and run your stop above your break even. You don't get moves like this all the time. You just don't. So you've got to do something about it to try and capitalize on the opportunity it's given you.
But well done, anybody who is involved. BAE Systems up 1.3 now. Fresnillo had numbers as well. They are up 3%. So there was a special dividend in there. Producer Fred was good enough to shout that out to me this morning as soon as the numbers hit the tape. Special dividend in Fresnillo being rewarded by 3% there.
Yep, their gold and silver production figures were in line with guidance, but I think that special dividend's given them a bit of a lift. Their full year FY24 EBITDA came in beating estimates, 1.5 billion on a 1.45 billion estimate.
That was the silver lining.
The silver lining, yeah.
Severn Trent, again, people finding places to hide in this US washout. Severn Trent and the water companies are one place. Unilever is another. The tobaccos are another. You can see, why the risk off means that money has to go somewhere. Does it go into treasuries? Does it go into gold? Or does it go into defensive high dividend paying stocks? Your dividends start to look a lot better when we're getting 3 rate cuts this year in the US, never mind the Bank of England.
Yeah, it will do. Can we, with all of the headlines around Ukraine, let's take a look at Forexpo, because they are a domestic Ukrainian-based mining business. They're down 5%. So it is all, it's shaken out in all of the different parts of the sectors at the moment.
That must be new lows for them, is it?
It looks, well, they went lower yesterday. They went lower last week, but they're now trading 74 pence. Take it back a couple of days.
If my contacts in Westminster are to be believed and this deal gets signed, does this go back up?
So talk to me about that deal then. So this is a deal for the minerals, which would, I imagine, have some form of American backstop on the fence, because that was the whole purpose, right?
He's not. He refuses to give security guarantees, but he wants half of Ukraine's resources.
What for? What for?
Well, because he's already given them $300 billion, he thinks.
Yeah, sure. But it's a, it's my understanding is that they're going to create a fund and that they're going to be joint contributors to the fund, and then they're going to share profits effectively. Is that what the idea is?
That the what? Sorry.
So for this minerals deal, is that there's going to be a domestic fund that these resource assets are going to, be mined and put money into.
Exactly, it's 50-50.
And then it's going to get 50-50 split on the side of that. So
what does Forexpo do in that situation? That's the Andrew. If only we had Andrew McKelvey online. He is the Forexpo expert. But we need to find out what Forexpo's
assets.
What would happen there? Because that is assuming that we get a ceasefire, we get a peace deal, and Forexpo can start mining again in Ukraine and drive up those revenues. A reminder.
Well, is there a risk? Is there a risk that their asset gets nationalised?
That was my concern.
Yeah. Is there a risk that they just say, right, all of these assets that are currently privately owned, trading on multiple stock exchanges, they're ours now, and they're going into the national fund?
Which reminds me, before we look at another defence name, let's look at this idea. Well, Trump freezing US aid to Ukraine until Zelensky proves he wants peace. He'll be back in 2 weeks to sign that deal. But what about the other story that we've got Russian money being used as part of the deal?
Oh, so all of the seized assets.
Here we go. Yeah. So this is really interesting. There are 200 billion euros sitting in a Belgian bank, Euroclear. Guess what happens to the interest received on that?
Well, that's going straight to Europe, isn't it?
It's going into paying off the debt to European countries that they've lent to Ukraine.
Okay.
So they are actually getting the money back from the loans.
Well, I mean, I can understand that.
Was 5% on 2 years of 200 billion, so 20 billion, and they've lent them 50, and they've already received 20 back. Not bad.
Hey, it's not bad. Yeah. But I suppose the risk on this though is if Trump is now, because there were also with all of the deluge of headlines and everything that was going on, it's if he's now going to he's trying to bring Russia to the table effectively. So is he going to now start to make concessions based on sanctions in order to try and do so? Would this form part of those conversations?
Well, no, this is Europe trying. There's a real break. Europe wants one thing and US wants another at the moment. So at the moment, clearly Trump and Putin have made a deal, right? That deal is what Zelensky dared to go against, to challenge.
Yeah.
And that's when Vance and Trump pounced on him. But then Europe and Ukraine also, have a pathway. Now, how are those two going to line up? And does Trump even care what Europe wants? Because this is Europe's decision, and they'll obviously have said to Trump, look, we're not going to confiscate 200 billion euros. And Trump will say, damn right you're not, because it's the Russians' money. And it's, in everybody's interest not to take it from the oligarchs.
Yeah.
Because that would not leave Putin happy. But is there somewhere in the middle that Europe can use this as a threat that if Putin breaks the ceasefire, they take the 200 billion.
Well, they've already got it, right? So it's whether they keep it and whether they stop using it for other purposes. It's going to be interesting to see how it all shakes out. I still think this is all part of some kind of posturing, some kind of look at what we can do to make everybody fall in line.
Yeah.
It seems like Zelensky and it seems like Ukraine are now in probably the most powerful position they've been in, right? Because they've now got the decision to make.
Oh, I go the opposite.
You think?
Oh, this is Putin's dream. He now has America fighting his corner
For him.
And because it's in Trump's best interest and it's in Putin's best interest. You know, it's Europe that has to sprint to keep up. Is
there a way where the markets are concerned that the US backs out of NATO? Is that a very real threat, like everyone seems to be thinking of? Because I was looking through Twitter and looking at just the kind of general discourse through financial Twitter and everything as a result of, you know, the weekend when you saw all these pictures of Europe, all the leaders around a table, and everybody clearly there were American people that were tweeting were just like, doesn't look like we fit in, lads. We don't think we need it. You know, so is there a very real risk that this now starts to fall apart?
Well, and I think that's why you're seeing yet another defence company. I mean, look at this. This is Hensoldt that has moved from 35 to 70 in
a short space.
What's that? 2 weeks? Yeah, 3 weeks. So you're seeing Thales, you're seeing Hensoldt, you're seeing these huge moves because Europe is being told it has to step up to the plate.
Yep.
400 billion euros from Germany, an additional 0.5% of GDP from the UK, you know, along with everybody else, that they've got to start contributing to NATO because, you know, Europe's taking the P for too long is Trump's
shtick.
Yeah.
Let's take a look at Germany just before we take a look. Can we look at the DAX just because it's down 1.6%, nearly 370 points. So if we just pull the chart up there, obviously it had a huge run yesterday. You know, an absolutely monster run on the back of the estimated, what was the estimated spending?
Yeah, 900 billion.
900 billion.
500 for infrastructure. I wish I could think of a telecoms company that was particularly leveraged into Germany that would benefit from 5G infrastructure spend, and 400 billion on defence.
Yeah. But look at that. I mean, it's just been coming off. Is that coming off since 12 o'clock yesterday?
It peaked at 2.
Yeah, I just remember looking at it all morning going, it's just so momentum strong, but got caught up in the rest of it. But that is a horrible red candle in the last 10 minutes.
Yeah.
Look at that. Well, since the open. So what's driving that? What's formed? It'll be all the automotive businesses.
Risk off.
No, but that'll be all of the automotive companies that are going to get in the crossfire from these tariffs. It'll be Volkswagen, it'll be BMW, it'll be Mercedes-Benz. No doubt that that's going to be what's causing that.
There we go. That's exactly right. Yeah, BMW,
Siemens as well, Mercedes-Benz,
even Deutsche Bank.
Why Deutsche Bank? Have they got some kind of bond risk to?
No, I think it's just the DAX in general, isn't it? I mean, Adidas as well. That's obviously tariffs, China spending. Right, we've got, now we're going to do fast markets. We will include WH Smith in fast markets, Max. I haven't seen that one. The fact you're asking worries me. Am I losing money on WH Smith? I would guess so. And yeah, we're going to look at gold as well. So fast markets coming up after the break. We've got an update there from Andrew McKelvey. Yeah, plenty to come back for after the break in 3 minutes.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket.
Welcome back. It is Fast Markets on Tuesday, and we are going to try and rifle through some of these. So, we were asked on the chat, WH Smith, let's take a wee look, shall we?
A wee look. Right, so yeah, WH Smith, I bought it yesterday. I originally wanted to get involved in this as they stated there was a chance that they would look at selling the high street business. The high street business, of course, the one that is really holding it back. We all know we'll spend £5 on a Mars bar in airport if we want a bloody Mars bar on that flight. I'm a discos man, salt vinegar discos, every single flight. They could charge me £8 and I'd buy discos.
Discos is such an old school snack.
It's so random, but
It's so random.
So WH Smith, if they get rid of the high street business, which was talked about back in January, you saw the move from £11.50 up to £13, and I was annoyed that I wasn't involved. So I bought them yesterday on the open at £11.60. Today trading £11.40. General market sell-off. General concern about the consumer, but this is one that I'd be looking to top up rather than to be getting out of.
Okay.
Diageo, sir.
Diageo. I mean, look, they're trading at lows. If you want to bring their chart up, Diageo, where do you start? Look, there's been lots of talk about whether they're going to spin out Guinness or not, and the business has been struggling. What are they going to do with their portfolio of assets? But they're going to get hit with tariffs because, of course, whiskey and alcoholic beverages is a big import, or sorry, rather an export into the US. Johnny Walker, the Americans love drinking Johnny Walker. So you can't get away from this chart. Look at that. That is a double bottom. You know, would you be buying it? Would you be selling it? I think you've got to wait for it to break that range.
And the big problem, of course, is that they are heavy in tequila. There's only one place that you make tequila. And then also you've got the Canadian whiskey business as well.
Been drinking a lot of tequila recently, actually. I've been watching loads of Yellowstone. Have you seen Yellowstone?
No.
Kind of cowboy show. Anyway, you double tequila, sparkling water, and some lime juice. They call it a ranch water. It is chef's kiss, banging. They got
ranks on Diageo.
They got downgraded yesterday. Deutsche Bank said they've now got a hold rating on them with a £20
upgraded
target.
They were upgraded yesterday at Deutsche.
Really?
Yeah, because Deutsche have nailed it on ABI InBev and on Diageo, and they upgraded them both yesterday. But only to a hold.
Only to a hold.
With a 2020 price target.
Yeah, below where the market's currently trading at. So the average target there, 26.46. Buy the dip, not sure. I think for me as a trader, I'd want to buy if it breaks out above, where's that chart again? If it breaks above 22 quid and it starts to make higher lows,
Okay.
I become interested.
Let's put an alert in there then.
If it breaks below 21, I don't know where the support would be. Where, has it ever traded lower than 21 quid? We're now at 21.30 now.
I've just changed to Solana. I've still got that. I put that in on Sunday to keep track of the moves in the Trump and his friends crypto. But there we go. So
the 21 would be the low in COVID. Before then, which it bounced off of immediately. Before then, you've got to go back to January 2017.
Okay, so I'm putting an alert in at £21 and £22.
20, yeah.
So either buy on weakness or buying the breakout.
Buy the breakout. Only if you start to see a close above that kind of 22 level, and you start to see it make higher lows.
Okay, right.
Where are we going to look next?
Ask me about Cisco, aren't you?
Yeah, as if you read my mind. San Francisco.
San Francisco. Look at this chart, right? It's not talked about much, is it? It's in that sort of range of IBM, and then
the old school, Nasdaq, tech stocks, isn't it? It's what would you say Cisco's key business is these days? Networks, data centers, comms.
Also a bit of software as well. So they are they've branched out and they've become a really interesting secondary play. Right, and this is where I think you've got a chance to see the money flows next, right? We know it's coming out of Mag 7, right? We've seen that the last few days, but where is it going? It's not into the power names like it was last year because there's concerns around data centers now, but is it in the switches and the and software like a name like Cisco? So you've seen a nice move so far, but if we go out further back, you can see this has been left behind, right? We're only back to where it was at the start of 22. We've seen the Dell move. We've seen the Oracle move. Is this one of the ones that could be next? 71 price target. Let's see who the big bull is. No, they're all around 80 at Rosenblatt. But yeah, this is one I would like to look at on Tasty, on the options.
Well, just while you're there, just look at the Smart Score. Go back onto our platform, on the IG. Go back to tip ranks at the top.
Mm-hmm. Boom.
And then this one here. So why do tip ranks see this as a 9? So they're showing of these 7 or 8, 5, 10, I can't count this morning. Why is it showing it as an outperform? So there's a moderate buy on the analyst consensus. They're seeing bullish news, bullish blogger sentiment, and a positive crowd wisdom. So sentiment behind the stock is clearly very, very strong. Technically, there's momentum behind the stock. The return on fundamental equity has been growing. So business-wise, it's looking pretty good. Fly in the ointment, there's been $500,000 worth of stock sold in the last 3 months.
So Monkey Man rightly pointing out they also benefit from cybersecurity. So it's just got a nice portfolio there where I'm happy to look at the moment with watching the stock at the moment. As I said, I'm not adding to risk today because I want to see whether that VIX goes above the 22 level. But if we do see a drop in this, I'll definitely be interested in selling puts. At the moment, IV rank only 21, but we're at that 44 days to April, selling something along the lines of a 60, so a put at the $60 level. It's got a 23 delta, and I'll be taking 72 cents till April. Not hugely exciting, but
juicy.
One to look at. Maybe better to invest on the upside and see where that goes.
If there's a call spread or something like that to do.
Shall we talk about TSMC?
TSMC. Yeah, TSMC. They announced that there was a big $100 billion investment into the US yesterday. So It slightly got washed away, I think. That's SMCI. I think it slightly got washed away with the rest of
Taiwan
the market
semi.
news. Taiwan semis. Now, this I thought was quite interesting because I pushed this out as a little text message to the clients that I look after, and quite a few people came back saying, what are they buying for that $100 billion? You know, something tells me that they're buying some form of security.
Yeah,
on the
so
back of that
it's not the five plants they're building you're talking about.
But it's symbolic.
Yeah.
Why now? You know, when Trump's kind of got Europe in the crosshairs and he's trying to figure out what's going on over there. Don't forget about what's going on in the East. Don't forget about China. Don't forget that as of yet, TSMC have already got, you know, a plant that is being built in Arizona, I believe it is. Now they've committed a lot more money behind it. So I just think this is going to be one to keep an eye on. I think there's a reason why it's been done now, and I think it's one that you're going to want to watch.
How do you trade that though? I mean, it dropped as low as 165 yesterday, and it's, you know, it's down. My goodness, it's down from 200 to 175 in 6 days.
Well, you can. I mean, I imagine the IVR on this will be beefy.
Beefy.
If you put some form of iron condor or some form of, you know, defined risk volatility selling option. Maybe not today. If you're right, you know, we want to keep an eye on where that VIX goes. Yeah, 64.5. So, yeah, high, elevated.
Ooh, look at that, 64.5, and you get 224 for selling a 140. I think that could be my trade of the day.
There you go. Look, 12 delta, and you can still get a decent amount of juice out of it.
That's beautiful.
So 140.
When was it last at 140?
140 in August of last year.
Oh, on the 5th of August.
Yeah.
Oh, that is nice. Now, I cannot, you might have seen me laughing. I wish one day we'll put the comments up on the screen, but just take a look at that last comment, because that has me cracking up. What accent is he saying this in, do you think? Pelican, Scottish man. Outlook for the rest of the US markets, question mark. I love it. Pelican, come back every day, please. I want much more. Scottish man.
Scottish man and English man. It's almost like a setup to a punchline.
It is brilliant. Yeah, are you English man?
Yeah, I'd have to be English man, yeah. Yeah, no,
Right.
I am 100%. Actually, a quarter Irish, but I think most people say they are.
You, Pelican, you can call me anything you want. Just call me Scottish in future. So, yeah, the outlook for the US markets. Well, we have said, is this GDP now, is it correct, right? And if it is correct, is it because of the
Import effect.
the really getting your money out there and buying the goods from tariff hit countries ahead of time? Or is it gold? Is it the Federal Reserve and Fort Knox
Restocking.
restocking the gold and dollars flowing out and gold flowing in? Is it a combination of the effect? But is it going to flow through to numbers? Because these are some scary, scary numbers, down 2.8%.
I still think it's just getting wiggle room for them to be able to cut rates. I still think it's part of Trump's master plan. You know, whilst he may be
Chart off, please, guys.
why he may be Trump and
Thank you.
you know, say what you want about the man, but he surrounded himself with a fairly competent cabinet. And Besant, who's obviously head of the Treasury now, is not a muppet. So it's going to be one to watch. Just on gold, we obviously have had a 3-week, you know, huge run up as part of this long kind of uptrend. So if they are looking to restock, if there isn't gold there, you know, would you say that their forced buyers has now started to back off a little bit? You know, we were up at 29.40, 29.50, and we now, you know, we saw 3 weeks. Well, no, last week we kind of gave most of that back, which helped my short calls a little bit. Back above my short call strike at 29 though.
So I added yesterday, I added to my GLD. Let's look at where that is at the moment. Now this is complicated because I've got a load of March positions. I added to it. So I wanted a short term move up in gold, and I expressed that. Now I'm going to have to pick out what I did. I'll have a look at the activity rather than because there's so many there. There we go. Right, GLD. This is what I did yesterday at 4:47 p.m. when I saw the GDP Now number. So I bought 2 of the 270 calls. Remember, gold is trading now at 268. So pretty much at the money. I sold twice the amount of the 280 calls. So that's a 1 by 2. So my break even is 290, which is 7% higher than here. 6%, 6.5%, which would take us to 3,050. So my break even's 3,050 this month, selling 2 of the 255s puts. So I got that on for $1.11 and the upside is $10. That's the way that I'm playing gold. I think we go higher. I'm also long on my portfolio here. Let's see. Yeah, long £15 a point, which is about 43,000 sterling of gold from 28.44. That was on Friday night. We just broke in 2,900.
Came through this morning.
Wow. Okay, I hadn't seen that.
Yep, 2,900 back above.
Okay, so that's going to be a good day in GLD as well. Hopefully, there it is. So back towards the highs, GLD, we will leave you with that. Luke Moore, thank you very much for joining us this morning. Englishman.
And Scottish man, thank you for joining us.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
You can find a variety of asset classes on the sidebar menu to the left of your platform. It's now time to pick an asset class. There are 4 major types. 1. Shares in individual companies listed on global stock exchanges. 2. Indices, a group of shares measuring the performance of a particular region, exchange, or sector. 3. Forex, the value of one currency compared to another, like the pound versus the dollar. 4. Commodities, like gold, oil, natural gas, or wheat. Decide which of these markets interest you and which you know the most about. It's up to you to research the market you'd like to trade. This will help inform any trading decisions you make. You need to know the risk of trading a particular market. For example, some markets react to events like economic releases. Next, look at the market's opening hours and how they'll fit into your trading plan. The deal ticket will let you know if a market is open or closed. Lastly, look at the costs and charges applicable. Once you're happy with your market choice, place a deal through the deal ticket.
Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose. Hello, welcome to Trade Expectations with myself and Matt Arbour. Thank you so much for joining us.
Morning, Ange. How are you?
I'm very good. What on earth is, I'm loving, obviously, the markets, really exciting stuff at the moment, but it sounds even more exciting, the vol desk. Elliot Harris going, can't come talk right now, it's hellish here. Jack saying vol ticking higher,
Oh,
it's
yeah,
all kicking off.
What a day yesterday. Sort of fairly calm on the open. We spent the morning watching the DAX just rise inexorably higher and higher and higher. Whole of Europe hitting all-time highs in the morning. Sort of this rush to buy defence stocks, and I suppose part of the story there in Germany that went a little under the radar yesterday is, I know I was certainly scratching my head as to why, as we're seeing the tariff story, keep on not dying away for Europe, and European car manufacturers going higher. I don't know if anyone else picked up on that the EU relaxed the rules on quotas of EVs that had to be sold. So that's why we saw the pop in the German autos, which is, all those people scratching their heads. Why is the DAX up 600 points? 600 points.
Yeah.
On a Monday, but that was part of the driver. But then all changed once the US came in.
Yeah, it was definitely all changed. Just showing you the hourly chart here to show you what we mean. Also, today BMW down 4%, all hurting here, people, all hitting reverse gear. Let's have a look at the indices as well. Yes, there was this talk sort of after lunch, everyone's discussing, especially here at IG, many of us analysts going, will he, won't he, is Trump going to do that roller disco again, right? Roll back.
Exactly.
Right? But he didn't, and here we are.
But it was kind of one of these, a bit strange almost. Again, I hate to say that crypto could lead anything, but precipitated that the Bitcoin move, the big crypto rally from over the weekend with all the reserve talk, etc., started turning around as the US came in. That accelerated, and we saw indices almost following lower. Some of those crypto stocks, MicroStrategy was up 10% after the all sessions of the morning and finishes down 5%. These are some really quite extreme moves going on, and that's reflected in the volatilities. The headline daily index vol, which was higher yesterday, sort of around low 20s on the S&P yesterday on a daily. That's as high as 30% this morning, so that's sort of a 50% pop. So there's definitely some vol returning to the markets, and whether it's risk on or risk off, it's just saying there is a lot of uncertainty about.
Yeah, totally. And just looking at the pop that we saw with MicroStrategy, we did see that gap close quite quickly, but just having a look at some of the others as well, having a look at Wall Street, we've got Pelican. Welcome, Pelican, to the show. I don't think we've spoken before. Pelican asking if we could take a closer look at US indices. Let's start off with the US 500. This was the view. This is the hourly chart here for you.
Which is, it's kind of a crazy chart, isn't it? Like you don't see that on a day without, I don't know, sort of a major US number. I suppose we had an ISM number yesterday. We had sort of a minor, would you have a GDP at half one? Whatever. There were some smaller US numbers, but not numbers that anyone was really pinning the week on, and we're seeing that.
Are you on the camp where all this was kind of triggered by that Atlanta Fed estimate, you know, saying that, oh, it's not going to be negative growth, you know, GDP instead of positive. I mean, I kind of think, yes and no, we kind of knew that
Exactly.
they were progressively already, you know, tightening and actually lowering that view since Christmas, really.
Exactly, and hanging on these sort of slightly eclectic. The one that always gets me is with payrolls, and you look at the headline number on the payrolls, then you look at the revision on the previous month's payrolls, and those revisions are often, you know, chalk and cheese compared to the number at the time that had a strong market move. So now the Fed itself has the sort of its own set of leading indicators, and it's, you know, kind of has a first look at the numbers anyhow. Any separate statement, is that really changing the overall view? This is all much more Trump related stuff. This is, you know, there is a perhaps genuine uncertainty in the market whether it's the case, and I haven't looked at the numbers, whether we have seen some liquidity come out in the market, which is why we're seeing these more extreme moves. You know, people, if you are long-term money, do you want to be sat in there on a daily basis at the moment? Perhaps not. You're taking some more money, sit on the sideline and wait for the opportunities.
Yeah, we are seeing the VIX ticking higher there. Also, Pelican and many of our viewers, Monkey Man, Julian, good to see you back on the show. Also, Andrew McKilvey piping in. We thought maybe you had the day off, Andrew, but you are here with us. Wonderful, talking about Frexpo. But let's refresh our memories. And for those that have just joined us, we now have these new 25% tariffs on imports from Mexico and Canada, which took effect as expected on Tuesday, and a doubling of duties slapped on Chinese goods to 20%. Pay attention to a lot of the tradable stocks here on the IG platform that are going to be hurt by the de minimis loophole that Trump is also going to, if he hasn't already, close. You know that if you send things over, if you're like a Shein or a Temu, and it's $800, it goes in tax-free. Now that loophole is also going to be closed.
And of course, amidst then it was a flood of actually news yesterday. Oil yesterday, we saw OPEC's Plus looking to pump more, which is, you know, we saw oil come off as well. There was a lot of information out there, a lot of things for the market to look at yesterday. And I suppose that oil being slightly pertinent, the amount of oil that Canada export to the US, you know, and again, without getting too technical into weights of oil, US crude is a different type of oil to the crude you get in Canada. The US, you know, we all know has a lot of oil, but Canadian oil is better for refineries.
Yes, there are many grades out there.
Yes.
Yes. Malaysia has first grade oil, which I am, so my brother works for Petronas, which is the equivalent of their BP, their oil major, right? But theirs is state owned. I always find it really, really ironic. They sell all the best stuff because it has the least contaminants when it's being used. Yep. And then they import the really terrible stuff to use, you know, in the country. But that's how they line the coffers. But you are absolutely right. There are many different grades to oil.
But with that oil, so it's for yesterday, the sort of strange dichotomies with Trump, and it's drill baby drill in the US, and he's celebrating OPEC Plus, you know, producing more. No one's going to turn on the drilling in the US if the oil price is low. You have OPEC increasing production drives the oil price lower. The guys sat in the Permian Basin don't turn on their rigs unless the oil price is over $70. So it's a kind of strange one, but there are a lot of factors in the market. Yes, there's a lot for people to get their teeth into, and dare I say, it gives you opportunities as a trader.
It does indeed, and many of our trader friends here asking us on the show. So happy when you give us specific questions, which is great because we like dealing with specifics here. There was a brief moment when I was looking at the feed and it was going so fast that I couldn't quite write all of them down. So here are some of them. Can you discuss US markets, how to play that in a down market? We've talked about that. We've talked about crude as well. Also, we have Monkey Man asking about Amazon as well. Monkey Man, do you have a position in Amazon? Is that why you're asking us about this? Because my view on Amazon is that I'm currently bearish. As long as this tariff talk issue is going to continue, I am slightly bearish on Amazon because of, rising costs by getting stuff, across borders. We already know that Trudeau, whom I've met actually in Davos.
Name dropping there. And she was at Davos. Here we go.
I have actually met him.
Those are the rich and famous.
Very tall. Would hit back with an immediate 25%. He's got better hair though. True. 25% tariffs on circa $20.7 billion worth of US imports, and potentially a further 86 billion if Trump's tariffs are still in place for 21 days. Then we haven't even got to the Chinese yet, who I'm sure might say something in the next 2 days because they've got their dual sessions, or 2 sessions rather. I mean, are you expecting, is Vol telling you that this is all going to get much worse before it gets better?
Well, as I said, the vol on headlines, and S&P vol is 40% higher just on the daily, so from yesterday to today. And yesterday was already about 10-15% higher than where we were at the back end of last week. So the markets are, the markets are pricing in more large moves is very much the case. There is there's not a strong directional bias here, but we are suggesting that we are back in for some choppy trading sessions.
And like you said, there are opportunities on all fronts, one of them being defense. We talked about this yesterday. I did some homework after our chat yesterday, because I like the fact that you said, somehow Europeans and leaders are going to find the money from somewhere, right? Rich keeps saying there's no money in the coffers, they have no money to spend on anything, it's dire, the budget deficit, dire. But actually, I had an epiphany and I thought, wait a minute, this is an excuse for the leaders to go, well, we have to tax during wartime, right? And I have data to show you. We have got graphs, which I'll share with you, that show that taxation does consistently rise during wartime efforts.
Well, is this coming as a surprise to any viewer? I don't know. I don't know. Wars cost money, don't they?
Yes.
But yeah, in that EU world where money is always found for national champions, and the market all over that, no surprise that the biggest defence winners yesterday were German defence companies, so Rheinmetall and that very, very strong move.
And we're seeing that still continue in today. Just whacking up my chart there for you. Rheinmetall still up 1%. BA Systems after yesterday's stellar performance. Sachs.
Is that another 10% on Thales?
Yeah.
Wow.
And another almost 10%, 9.3 now on Thales. And yesterday when I mentioned on the show here, with Matt as well, when you see BAE Systems move, because it's such a monster in European defense, right? Yesterday you saw a big move there, just showing you the chart here. It is likely that it will move the other monster in the USA because of the way they've always moved. Northrop Grumman there, just having a look there. And as you can see in the previous session, let's make that a bit smaller because I can't see that now. It did move higher in yesterday's session. We don't have Northrop Grumman all sessions yet. I wonder why. But it's a very, very liquid stock.
Yes, it's one to have a look at. It's not a stock that people have a great deal of interest in generally. But of course, at the moment, there's a whole spectrum of stocks there. It's something for everyone, so interest do wane. So we do endeavour to pick up what people are trading and to bring them online onto the session. So it's one to have a look at. Right,
now how much time we got left? We are wrapping now. We have to go. This is so much fun. It always feels like it's only like
time flies. But
and just before we go, we have a big birthday here. He is going to celebrate a birthday with us on Thursday. So trader friends, he won't tell me his age. Any of you like to guess? Any of you like to guess? A sweepstake.
On how old I'm going to be.
Pre-NFP sweepstake will be Matt Arber's age. Whack your guesses right here, and there'll be a prize. See you soon.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
To find a list of all your open trades, click on Positions in the sidebar menu on the left. Here, you'll be able to see key information about each of your trades, including the market name, the size of your position, the opening price, the stop order you chose, and your limit order. You'll also be able to see your profit and loss. Positions are normally sorted in descending order of your latest trades. To change how your positions are listed, you can filter your view by clicking on your preferred factor, like which trades are making you the most money, by selecting profit and loss. You can edit your limit order or stop order by clicking on the figure and entering your desired number. Lastly, you can close your open trades by clicking on the Close button next to the relevant trade.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Right, Scottish man back for the all sessions opening bell. Are we ready? It's going to be a volatile one. I got hammered on Nvidia yesterday. I was buying on the way down and it was not the right thing to do. But we are looking at a small better futures this morning. So small better on the futures this morning. That's not it just yet. We've got a minute to go until we get the all sessions open. So yeah, come out of that, please. That's not the right moves. But what are we going to see this morning? Arsik Sena saying, trying to be away from US stocks at the moment, especially the tech ones, right? There's always room to be looking at diversifying your portfolio, looking at the defensive as well as defense, right? So defense stocks are the place to hide at the moment, but also the defensives, the high dividend yielders and the safe dividend yielders. There's a great ETF, if you look it up, called the Aristocrats. And these are companies that haven't cut a dividend for 20 years. They do a small increase in the dividend per year, and they've got a high dividend ratio cover, right? So they're not really extending their balance sheet or using all of their EPS to pay the DPS, right? So dividend aristocrats, great one to look at. Now we're going to that US market open, and we're going to get all sessions opening right now. What are we seeing? Delta Airlines down 1.2 and Tesla dropping back 282. That was after the upgrade from Adam Jonas yesterday. Adam Jonas, one of the best auto analysts there, adding Tesla to his favorite picks, dropping back yet again 80 basis points to 282. What are we seeing on the upside? Are we getting any relief in those big tech names? Intel traded 2470 yesterday. There was a story around that Nvidia were, Nvidia and one of the main competitors, Broadcom, was looking at using Intel chips. Traded right up to 2470. That one's worth watching. Let's have a look at how it did on the minute-by-minute chart there yesterday. Look at that, 25.50 it traded on that news and then dropped right back. See if we can get confirmation of the story. That's, yeah, 3rd of March. Intel rivals TSMC and Broadcom are reported exploring potential deals that could split the American giant. So there, that's another one, another story. 2 stories around in Intel yesterday. And you can see that one dropped right back to close at 22.94. One to watch today. Apple up 40 basis points. CrowdStrike up 50. Where's our beautiful Nvidia? There it is, up 40 basis points. A lot of people looking for the vol to come out of that one. I've got an options position in Nvidia. I know it is a popular one to have the options positions in. So let's see what the vol in Nvidia does today. Stock currently trading up 60 basis points. Netflix 975. And we've got, not many other movers there. With what about the what I like to call my my B chain, right? In my right-hand column, that's where all the real spicy stuff is. The MicroStrategies and Riot blockchains down 1.8 yet again. Bitcoin dropping away, now below where it was before the Trump tariff news came out. Riot blockchain down 1.4. Coinbase, let's look at Coinbase over the last 24 hours. Absolutely incredible. Considering the jump in earnings that they're going to have had over that weekend with people trading crypto, to see them actually lower than they were on Friday, I don't understand that one, right? I do not understand that one. We saw it up, I think it was 9% at 235 yesterday, and sold right back off to be down on the day, as did MicroStrategy. MicroStrategy I can understand a bit more because it's just holding a load of coins, right, on leverage. But this one must have had a huge upsurge in trading over the weekend and yesterday as everybody was adjusting their positioning. So that's an interesting one. I think I would rather be in Coinbase than I would in MicroStrategy. I don't think I'd be able to sleep at night if I was in MicroStrategy. So Intel up 1%. Nvidia starting to move up 60 basis points, 114.75. That one's going to be worth watching. But talking about my options position, let's look at where I sit with that now. My levels are short 85 puts for October, right? I don't think it's going down there. I'm also short the 170 calls because I don't think there is a hope in hell that it can get up to 170. That's $4 trillion market cap. And you could tell from Jensen's outlook that Q3 H2 is going to be particularly important. So I've chosen the October expiry, right? Every now and again, you go beyond that 45 days to expiry and you look as far out for a particular strategy. And my strategy on Nvidia is that the numbers are in November. So therefore, I wanted my position to expire before we get the numbers that will either be a profit warning on 75% margins, or he'll meet his 75% margin and the guidance there will start to look really juicy. So I got the 85 170 strangle. I'm short that, and I'm short in reasonable size because I'm quite confident about that one. However, the one that might hurt is being short of the 100 puts for May, and that was what cost me money yesterday. Although I am also short the 160 calls and the 180 calls, and also added a position yesterday of being short 145 calls. In summary, I'm long some stock, but I am short the upside in fairly decent size at 145, 160, 180, and October 170. Shorting puts at 185. You can see that's a whole load of short vol, so I am exposed to an increase in vol in NVIDIA, but for the moment, I'm happy with that position, buying stock as it comes down. Right. Talking about options, we're going to go back to our course, the beginner's review of classes 5 to 8. That's coming up after this quick intro. That's right, it's the beginner's options trading recap. Thank you very much for Terence for helping me to put this together. All Sahil's work that we've looked at in the 8 lessons so far, we've put them into 2 recaps. So yesterday we did recap 1, worth going back and watching if you missed that. It's an introduction to calls, puts, moneyness, and intrinsic and extrinsic value. Today we go to recap number 2, and this is when we get into some of the more technical aspects. Okay, so the first one that we're going to look at, and I've just been talking about it with NVIDIA right there, it is buying options versus selling options. So investors can fully protect a long stock position by buying a put, right? That's like your car insurance. You buy a put to protect a long stock position. Some people are doing that at the moment. That's why you're seeing vol go higher, because it's more worthwhile to buy a put in dangerous and worrying times. Traders can fully protect a short stock position by buying a call option. All right, so if you're short a load of stock like I am in, what am I short of at the moment? Good question. What am I short of at the moment? Well, I am short S&P 500. If I was worried that Trump was suddenly going to do a deal, right, or that the market was going to force if they were going to force a peace deal on Ukraine, and I'm short the German DAX, I might want to buy a call just to protect myself against that announcement. Now, investors can reduce costs and increase success probability by selling a call against a long position. I've just showed you that in NVIDIA. I'm long 300 shares, but I'm also short calls of 300 and more. So I am reducing the cost of that stock, and I'm increasing the probability of success by selling a call against that long position. It does limit the upside potential. That's one of the problems. Traders can also reduce costs and increase success probability by selling a put against a short position. So you want the stock to go down, hit your put, therefore you're put upon from somebody else, and that closes the short position. So you're short stock all the way down, and then it closes by going through that put level, and you're put upon. But again, you limit that downside from the reducing the cost. Investors can use short option strategies to profit within a price range by betting against price movements rather than for it, right? I showed you that October NVIDIA strangle. I am basically saying that between now and October, NVIDIA will trade between 85 and 170, and I'm paid, I think it was 6% for that. So I'm making 6% just from the stock trading within a range. Right, the next one. What about expiration and strike price? Okay, what do these terms mean? We're going through all the different terminology of the options market. Options allow us to choose different strike prices that can be above or below the current stock market price. Different expirations allow us to have shorter or longer term assumptions. Right, so my assumption is on NVIDIA that the really important set of numbers comes in November. Therefore, I think the stock trades in a range until November because you do not have clarity on the second half until then. Now, options have longer term expirations, then they've got more extrinsic value than short term, right? Remember, we went through intrinsic and extrinsic yesterday. Extrinsic value is the part that when you're not in the money, okay? It's all that, the time value and the vol, right, that move that extrinsic value. So longer term expirations have more extrinsic, and it gives them the higher premium value. For puts, options below the stock price will be less valuable than options above the stock price. For calls, options above the stock price will be less valuable than options below the stock price. We had a great question yesterday. Why would you buy a 130 call in NVIDIA rather than a 124 call where it was trading yesterday before the 8% sell-off? Why would you do that? Well, it's because it costs less, right? If I'm buying an option at 130, it costs me less premium than the 124. Right, next. Option trading lesson number 7 was the bid-ask spread and liquidity. Now, you all know what the bid-ask spread is because it's the same in shares, it's the same in spread betting, it's the same in CFD, right? The bid-ask spread is the difference between the sell and the buy, or the sell and the buy. Minimum bid-ask spread is 1 cent in options world. The goal is to be as close to this as possible, right? You want narrow spreads, mean much better results for us. A wide bid-ask spread indicates an illiquid marketplace. That's the problem with UK options and European options, right? They're not liquid enough. So they've got wide bid-ask spread, and that's really expensive to get on. I looked at Legal & General options a couple of weeks ago, and the bid-ask spread was 25%. 25%. I could sell at 3 or I could buy at 4, right? Now that is not a liquid marketplace. So yeah, fair price is unclear, and it might be hard to get in and get out of without losing money. Right, now, Scottish man, on to trading lesson 8. Options volume and open interest. Open interest, so important. That's when you know that there's going to be a lot of volatility and a lot of gamma, which we go on to next week, if the stock moves. Option volume represents the total number of options transactions, right? Stock volume represents the number of shares traded that day. So that's simple. That's just the number of shares that trade per day, the number of options. Same thing. That's your options volume. However, open interest, right? Remember that the bucket of open positions. Open interest is the number of option contracts that are open or pending at that strike price and expiration. That's when you can tell how much, how many people, how big positions are on that strike and that expiration, right? So you know that there's going to be a lot of hedging going on and a lot of vol trading around that level. And that's when people start to talk about an index or stock being pinned, right? P-I-N-N-E-D, pinned to a certain level is because there's so much interest around the 70 pence level in Vodafone or the 5,850 level in the S&P. If you're getting towards expiry, and a big expiry, right, 4 times a year, there's those Goliath quadruple witching. That's when stocks can come really pinned to a particular area, and that is because of options and derivatives traders having big open interest. Open interest only applies to options, nothing else, right? High volume and open interest generally indicate higher liquidity and a narrower bid-ask spread. Right, that is our 4 options trading and the lessons. Tomorrow we go back on to the new lessons, right? So these 2 last couple of days are really worth going over just so you can keep up with what we're going to go into this week. Sahil's got some exciting stuff planned for us. This is a 30 lesson class. Right, we're doing 30 lessons, all about 10 to 15 minutes long, on options trading. We'll take you from knowing absolutely nothing to being an options master in this tasty masterclass. So join us tomorrow for the next class. But coming up next, we've got Tom and Angeline all ready to bring you Tom's Takeover.
Planning to make investing your New Year's resolution? IG Invest brings their trading expertise to a brand new, simple and user-friendly app. With zero commission on US stocks, why wait? Download IG Invest today.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Are you ambitious? A future leader? Do you think big and raise the bar? If that sounds familiar, IG wants you. We're a global fintech and we offer graduate schemes for the ambitious. You'll see everything as you rotate across the business, building your skills and knowledge as you go. Kickstart your career as a future leader at IG, the home of the ambitious.
Hey, welcome to Trader Tools with myself and Tom Wolstenholme.
Good morning.
I am going to segue from your surname because it leads me to everyone asking, how is the home DIY of W Mansion going?
Oh yeah, I've moved on to gardening now.
Ah, okay.
I've left lots of unfinished jobs in the house
Nice. Yeah.
because the sun came out.
The ceiling is not leaking, right? The roof is
Ceiling's
not
not
leaking.
leaking.
Great.
Ceiling's not leaking.
That's
But I've half painted a load of stuff, got bored, gone outside because the sun came out, didn't it? And I've started to do gardening, which is new for me. I've never done gardening before. So I'm going to be relying on you, I think. Lawn maintenance is first on the priority list. I'm either going to remove the lawn and put new turf down or treat the current lawn.
nice. Have you got a scarifier?
I've got like a rake. I've got a rake.
Okay, that's a start.
Yeah.
Okay, have
So
you
I've been
got
raking it.
okay? Have you got a lawnmower?
There's the previous owner left 2 abandoned lawnmowers. I've yet to try and see if they work, but hopefully
Okay.
they work.
Okay.
In which case, yes. If they don't work, then no.
Okay, that's already a good start.
It's a good start.
Is your lawn flat? That's another important.
It is very bumpy.
Okay.
So do I need to get one of those big machines and
Yeah, and if you want a really lovely, what we call lines,
yeah?
right, where you mow in one way and then you mow the next bit another way, you get these lovely, lovely lines.
I'm up some lines, yeah.
Yeah, then you need to get it level, right? And you want to make sure there are no stones. You want to make sure that you get all the stones and nasty bits out.
So do I need like a roller, like a? I'm picturing one of those things, you know, they use for tarmac, where they're giant rolling thing.
Yeah, that was
Steamroller?
like 20 years ago. We've kind of moved on from there. There are these
Okay.
automated machines that
Oh,
kind of tamp it down for you.
Okay, okay.
But you do need to clear it of the debris and rocks and stuff and
Oh, it sounds like a pain.
and then level it.
Okay.
And then if you wanted to be really technical about it, as I have done before, you then put 2 long wooden bits at both sides. That you get another long piece, has to be super straight, right? Has to spirit level, has to be straight as well. And you make sure that it's really level, or you could use a laser level if you have one.
Okay.
It's just so
That's a bit much, isn't it?
well, it's if you want the beautiful lines and to be able to
Then
drink
I've got to make it really flat.
your beer, right? And if you don't mind that undulating, some people like that. It's
Okay.
just that it's difficult in the long run.
Yeah. Oh, it's a lot to think about. I'm going to make a plan,
Yeah.
and I'm going to come to you with the plan next time.
Come,
and
yeah.
see it and see if you.
Don't use Roundup, the buyer stuff that we all know pulled its share price down. It's now recovering from that because it put a ring fenced it and basically got rid of that problem. But yeah, don't use Roundup.
Okay, and I have to ask, will you be remaining in the studio for the entirety of this segment, or do you plan on running out again? Because for anyone that was watching on Thursday, we made it through, what, 2 minutes? And then
We
you
did.
just sprinted out the studio and left me for what felt like a year on my own. So are you planning on being here for the whole?
I am planning on being here. I did actually, trader friends, I did go and apologize, later on. It was the first time I'd ever done it in my career, my
Your
very long
broadcasting career.
Yes. But we had Dylan Rattigan on from Milan for the first time, and it was not working out there. I could tell that wasn't working. I had to take remedial action.
You were tech support.
But I was tech support. I became tech support people, not just a nice face here. But the Jack and Franz Kana had it right when they said she did it because she had faith in you. I would not have done it if it was anyone else. You see.
Well, that's good to hear.
And I tapped Rich on the outside. Get in there. Well, we got Dylan up in the end.
Good.
Speaking of which,
and we've got bums and seats now, so that's good.
Bums and seats. I'm not going anywhere. Very excited to have you on because our viewers were asking yesterday if you were coming on, and I said definitely yes.
Oh, that's nice.
Let's and they want to know more about, because of all the volatility we've seen in the last 2 sessions. They want to know how to play this tariff and stock rotation that we're seeing in place right now.
Yes. Cool. So what I thought we'd do is, so we've had a lot of questions about European stock rotation, haven't we? And also about tariffs. So there's a couple of things I wanted to look at. So first up is, I quite like putting a chart on top of another chart to see what's going on. And that's something you can do in TradingView. So I've shown TradingView before, but for anyone that doesn't know, it's a third party, but you can trade IG products through TradingView. But it's a different charting package that you might find useful. So to access TradingView, you just go to tradingview.com. This is what you see, this cool dude in his jacket. And their charts is called Super Charts here. So you go to products, you go to Super Charts, and it opens up a chart. So first thing to mention is, if you're on TradingView, you can trade your IG stuff.
Yes,
right?
you can execute via IG.
You can execute, you're executing with IG, but you're using the TradingView chart. So if I want to make sure I'm connected up to my IG account, the first thing that opens automatically is just Apple, right? And if I just click buy, which was top left here, underneath it's where it says Apple and NASDAQ, I've clicked buy, and then you need to connect to your broker. You select IG, it'll say ready to trade, and you need to log in. So if you don't have an account with TradingView, you'll need one, but it's free. So you click join for free. This is me signing in.
This is you climbing that steep cliff.
This is me looking first, then leaping straight into TradingView, right? By signing in here. So once I'm signed in, I'm now signed into TradingView, and then it's going to ask me to sign into IG as well. And you sign into IG using your, I can't talk and type, using your IG login, right? So I'm now logged into IG on TradingView, and if I wanted to, I'd be able to trade this through IG. So, but the reason I'm coming onto TradingView is because we wanted to look at Euro stock rotation, and so I wanted to look at a couple of charts at the same time. So if I search for, I've got the IG tab pressed here, which means it's only going to show me IG markets.
Nice.
So I've typed in EU, I'm on indices, so I can bring up the EU Stocks 50. So Euro Stocks 50 index, I can bring that up like that. And if I wanted to, I'd be able to trade that from here. But the reason I want to do this is because I want to look at it against the S&P 500 as well, because then we can see kind of what's going on between the two. And I think on the same chart, it's often quite useful. So we've got EU Stocks 50 up, and then above here, top left, which is where my cursor is, I can see compare or add symbol. Can you see that?
Yep, the circle with the plus in the middle.
Tiny little circle with a little plus. And if I click plus, then I can go to, IG calls it the US 500. So I can hover over here. So if we pause here, so it gives me options of how to add it to the chart, right? So if I just clicked it, its default is it'll put it on the same chart, but it'll do it as a percentage change. I actually quite like it as a new price scale, which you can select here. So it'll put the price scale of one chart on one side and the other on the other. So I'm going to go for new price scale, but obviously the choice is there if you want it. So if I go for new price scale, what we can see here is you've got the two charts at the same time. I'm going to make them both aligned so it's a bit easy to see. There we go. So we've got EU Stocks 50 versus S&P 500. And you can see Stocks 50 is sitting here above. So you can see how they often track each other. but this dark blue one here is your EU Stocks 50. That's interesting, I think. It's got to the point where it's now sitting and it's overlapped and it's crossed over and come above.
Yeah, this to me is a
S&P 500.
pair. It's a nice pair.
A nice pair.
Yeah.
Because what? But you think it's a pair because they've come together and you think they'll diverge again?
Yes.
Yes, potentially. So I guess the reason I'm showing this is because we've got these questions about stock rotation. I think this shows kind of quite well the fact that you have got European stocks climbing and you've got S&P falling.
I would almost argue that you'd probably see the same as well if you charted the DAX versus the S&P. And
Yes, because the EU Stocks 50 is the top 50 stocks in the Eurozone.
yeah,
DAX is just German stocks.
Yeah.
So yes, you would see almost that.
this is really, really handy, especially in a time when, everyone's, trying to figure out and navigate this new space that we're in with, the tariff Trump war is firmly in play now. And we could potentially see, we've got Canada already saying that it's retaliating, and potentially we're waiting to hear now from China as well. Also, taking a look at, I guess the handy place to find how to play this defensively or even tactically if we are in a down market with high volatility is by using a stock screener.
Definitely.
Yeah, so
Yeah.
shall we get a run through that for our viewers as well?
I think so. So if we wanted to look at European stocks and we wanted to see the various metrics that the European stocks are showing at the moment and compare them to, let's say, other European stocks or stocks within the same industry, we can use our stock screener. So if we bring up my screen, we've got IG platform here and we've got stock screener bottom left on that toolbar. And if I go to the stock screener here and I'm going to add it to my workspace to make it nice and big. So at the moment we've got, if we select our region here, at the moment we're looking at everything. But if we reduce that down to, if we take off United States and we take off Canada, and if we take off Australia, we're left with, or we'll take off UK as well, then we're left with Germany, Spain, Italy and France. And here we're left with, I'm sorted by market cap at the moment, and you're seeing your top European stocks here. Now, I think we've been talking about things like, we're now crossing over between this whole EU stocks rotation and tariffs, right? Because those two things are connected and kind of causing different outcomes. So we were talking about, if you wanted to talk about, let's say, automobiles, which we have been doing because it could be affected by tariffs.
They're already being slammed today, especially the German automakers.
Exactly. So I found that sector, if you go to sector, automobiles seem to either come into industrials or consumer cyclical for some reason, is what I found. So if you go industrials and consumer cyclical, we're going to start seeing our, let's take off consumer cyclical actually, because there's less of those. So if we go to industrials, we're going to see some of our EU stocks potentially affected by tariffs here. So take Volkswagen, for example. We've got Volkswagen here, and what we can see is P ratio of 4, right? P ratio of 4 is, look at how much lower that is to like your big American stocks. The big American tech stocks have P ratios of what? Above 100 a lot of the time. Whereas Volkswagen, 4.26. So that's the price of its stock divided by its earnings per share is coming out at 4. And if you look at its dividend yield, 8.62%. So the yield you're getting off your Volkswagen stock is about 8.6%.
So you're saying this is telling you it's a bargain right now?
I mean, it's saying that it's a lower valued stock compared to its American counterparts, and it's also got a strong dividend yield. Is what it's telling you.
That's a really good point, actually, because there are quite a few stocks similar to that. So I was yesterday looking at companies like Honda, like Toyota, because those two stocks have a huge I'm going to bring that up here, huge exposure to this ongoing tariff war that's been sparked by Trump. Toyota, for example, builds all of its Tacoma trucks over in the US, I believe. And aside from Volkswagen, Honda also sends 80% of its Mexican-made cars to the US. So there's a lot of cross-border issues. There'll be a lot of parts that are going to be taxed, some of them moving twice or three times across those borders, and they will be hit by that tariff net right now.
Okay. So Toyota, Japanese, have they been affected by tariffs?
They've been affected in that they have plants on the Mexican side of things, right? And
I see. So Toyota has plants in Mexico.
Yeah.
Mexico's been hit by tariffs.
Exactly. And they make it out there and then they move it back in to sell. And so they're going to be hit by these tariffs. Also, interestingly enough, let's go back to the screener again. Does it easily allow us to screen for pharmaceuticals, for example? Because the talk now, or the mood music, is that once Trump is done with sort of hitting the car makers with these tariffs, he's going to move the crosshairs over to pharmaceuticals.
Yes, so we've got it set to industrials at the moment, and if we take off industrials, if we go to healthcare, now I'm still on European at the moment. So I've selected sector, healthcare, I've gone region. So I'm just on those Eurozone countries at the moment. So we've got, are these the kind of things you were looking at? We've got Sanofi here. PE ratio of 23, dividend yield of just under 4%.
That's not bad, is it? 23. How is Pfizer looking, and how is do we have Bayer there? Because I think not.
So
Bayer.
Pfizer's American, right?
Yeah.
Admittedly, it would be easier if you could search, but here we go. We've got Pfizer here. So Pfizer has PE ratio of 18, dividend yield of over 6%.
Interesting. And AstraZeneca? Does it have AstraZeneca there? I can't see.
There we go. AstraZeneca is here. So we've got AstraZeneca, dividend yield of 2%, PE ratio of 33.
It's not bad. Yeah, I'm just looking to see how I can put together a list of those pharmaceuticals ahead of this, because, you know, obviously if they're going to be hit with tariffs, then they're likely to be one that you can take a bearish view on. Speaking of which, we have some questions. Many of our trader friends watching this asking, Tom, is IG spread bet account available on TradingView now? This is from Neil, away from the numbers.
Yes. So if we flick back to TradingView over here, if I make it nice and simple, if I take off this second chart here, so I'm looking at Europe 50 at the moment. If I click buy here, and down here if I click IG, so I'm currently on the spread bet account here. So this is me on TradingView on my spread bet account, not my CFD account. And yes, you could place a deal here. So I think in the past, SpreadBet IG account wasn't connected up to TradingView. We have since done so. So yes, if you have a SpreadBet account with IG, log into TradingView, log into your IG account on TradingView, find a market. We showed how to find a market where if you've got this IG tab depressed here, depressed, either way, then it will show you the IG markets here. You can see their IG markets because they've got this little IG symbol down the side, and I've pressed the IG filter. So if you wanted US 500, you would select it. Getting a bit of lag here, and then if you're logged in on your IG account, yes, you can place that deal through TradingView.
I love how it's also set up pretty similar to the IG platform, right? It doesn't feel like you're going to some foreign platform and placing your deal there.
It's just a chart, isn't it, really?
Yeah. But also it's on the right-hand side.
It's on the right-hand side. Deal ticket looks relatively similar. You've got a bit more variety there in terms of how you set up your stops and your limits. There's a bit to play with because you can set it by ticks or by price or by a percentage. So there's a little bit more to it here. But yes,
Yeah, and
It's quite
don't
similar.
forget, don't forget to select that IG filter, because that's a really cool function. RSAC's also chiming in with a question here. Tom, is there a technical indicator screener? I like that question for technical analysis. Is there one that screens out, for example, if a chart has, you know, hit the 200-day moving average, or if you wanted one that you know, was showing oversold? Do we have a screener like that?
So let's click on indicators here. So if we bring the screen back up again.
Slam the screen back up. There we are.
So I've clicked indicators here on TradingView. Now there is a hell of a lot of indicators on TradingView. Some made by TradingView themselves, some are community indicators. So anyone could write their own indicator using, it's called Pine Script in TradingView, and publish it. So if you're feeling particularly creative, you could make your own indicator, you could publish it, and people would like it, right? And you would see that people like your indicator. So if anyone spotted that there was an indicator they thought was missing, you could always write it. But the question was about, is there a screener for indicators? Well, you can search for, let's say you're interested in volume. If you search volume, you can see a massive list here of these volume indicators. And you'll also see, so the top ones are all made by TradingView. It's the TradingView team that work for TradingView have made those indicators. But if you keep going down, you'll see the community ones. So people have created their own indicators, and you can see that people have liked, 20.4 thousand people have liked this volume indicator, for example. So that's quite interesting. And yeah, these ones above, you're searching by volume and you're seeing all those volume-based indicators. So you could search by anything, right? You could search by strength and you'd see true strength, trend strength, relative strength. So yeah, I think that's quite a good way of cutting through what is a humongous number of indicators.
It's a long list.
If you had all the time in the world, I don't think you'd ever get to the bottom of all the indicators available. But at least if you had a rough idea what you were looking for, like strength, moving average, whatever it might be, yes, that is a way of doing that.
And definitely do not make that same mistake that lots of people do when they start off with indicators. They put so much on that it becomes like a spaghetti junction, and you don't really know what you're looking at. It's just completely overlaid with too many indicators, and you can't actually see the support and resistance and the price action. The most important thing is to understand what the price action is telling you. Away from numbers saying thank you very much, Tom and Angeline, for showing him that. Also Maturin saying in the stock screener you can do things like 20 EMA is higher than the 50 EMA and so on. Thank you so much for that. Wow, that's really cool. You can even can you rebase it? That is the question. Can you rebase these charts? Or do they just overlay? Are they automatically rebased?
So remember at the beginning I said that when you select two, so if we've got EU stocks 50 here.
Yeah.
If I add another one, you can, if I just click on it here, instead of doing a different price scale, it's done percentage change. So that you see how they've both started at the same point here, and you can see how they move away from each other or together towards each other. So yes, I think, would you call that rebased? I think you probably would.
It is, yeah. And can you put like 3 or 4? So for example, if I wanted Ryanair versus EasyJet versus IAG.
Let's see if we can do a third. So if I put, yeah, so I can do another one as well. So there are,
nice.
So I've now got on this chart, S&P 500, Euro 50, and DAX. DAX is the purple one, because you were mentioning DAX earlier. You've got DAX, this is the purple one. SPX is this rich mauve, I guess you'd call it, and then you've got your Euro 50 here. Look, putting them on the same chart, I always think tells you a story, because different charts, it's hard to, I find, look at different charts in different places and kind of see what's going on. Same chart, I think it's great.
Yeah.
Good way of seeing kind of comparatively what's going on.
I agree. And the function also exists in, for example, the Bloomberg terminal. And what's even handier is if you have your cursor at a certain point, for example, when they start to bifurcate or when they start to come together, there's a little handy, your cursor can move over it and a little bubble shows up. and you can click on it. It takes you exactly to the story of that day and what might have caused it.
Oh, I see. Okay.
Yeah. So it actually takes you, if for example, you know, all three charts aligned on the 20th of February, you know, 2005, it would take you to the news items of that time concerning those charts.
I know what you mean. So, for example, if we bring up my screen again, do you mean like this? So, if I went to say Nvidia here, let me get rid of my other ones so it's less confusing. Get rid of that. Get rid of that. Here. So look. So we've got these little markers here. So one is for earnings. So you click earnings, and it'll tell you the information about that earnings call or announcement. And then you've also got this dividends. And then you've got this little lightning bolt.
Oh, what does the lightning bolt do?
It's like a latest updates thing. So when there's kind of something interesting happening, you click the little lightning bolt.
Right.
And that will show you, or look, going a bit crazy on the Zoom, that will show you updates on that stock and some news there.
Yeah, it's not quite similar because you know the lightning bolts. I'm looking at your bottom. Thanks for the Zoom, guys. Could you tell that my eyes were kind of like going ghouly because
We've gone from them refusing to Zoom to now mega Zoom.
I love it. I love it. So, trader friends, if you see me turning that way and this way, it's because there's a much larger screen bias here. There's a much larger screen for Tom, but my screen's way over there. So I'm kind of like trying to see. It's similar, but your lightning bolt, is that just at the very end? Is that just the most recent point, is what I'm saying?
I actually thought it had it on multiple points along the journey, but maybe it doesn't.
Because the Bloomberg one is, they have something like the lightning bolt, but
I'm sure, but Bloomberg is very expensive, isn't it?
It's very expensive.
Do you have your own login?
I have a login, yes. I used to work there. We have special.
Oh, you get special
perks.
rates.
Yay!
So basically, that was just you showing
No,
that you have a Bloomberg login.
I really do wish that it does not come with that function because you have to pay. You know, there are different tiers. So I no longer have the one with all bells and whistles.
Right.
Same with Refinitiv. We only have the basic version here. We don't have the one with all the bells and whistles, the ones that give you, 1 hour, 1 hour to the cash open. It actually you can have a filter that tells you the ones that are most active on the downside and upside heading into that Wall Street open.
Say that again.
We don't have that.
So coming into the open, it tells you what the stocks that are moving most in the pre-market.
Yes.
Is that what it's showing you?
Yes, and it can filter top 10, top 5, top 3, right? Yes, we have the all sessions, but our all sessions doesn't capture the entire universe, right? The one in Refinitiv does. Maybe it's something we should do for our viewers, right? Right. Some questions coming in. Arthur Fox Haig, why don't UK stocks show up in the upcoming dividends in economic calendar in the IG platform?
Say that again. Why don't UK stocks
show up in the upcoming dividends in economic calendar in the IG platform?
Okay.
Let's hit up the economic calendar.
So I've got it here.
Yeah.
So we've got dividends. No. Oh. Is that a fire alarm?
I've been using the toaster again.
Attention, please.
I think we're having a fire alarm.
Oh my goodness.
Is there a drill for this? We've never had a fire alarm live on the show, have we?
We carry on. There's no drill. Yeah, we
carry
did.
on.
Yeah, we're being told there's no drill. Carry on. If you
So
hear
the
this
question was about UK stocks and dividends. So we've got next 14 days, dividends. You're right. I think there should be more showing up here. So it might be that they found a... let's turn everything on and see what we can find. Actually, we'll reset to default. Euro areas, Asia and Pacific, Middle East and Africa. There we go. You're right. I think there's an issue there.
Yeah.
Thank you to whoever points that out. We'll take a look at that.
Attention, please.
There's also a really good, and thank you very much, Arthur. We will stay right where you are because I'm going to give you a helpful hack right after this break. Welcome to the exciting world of options trading. If you're looking to add a new dimension to your trading strategy, you're in the right place. Options trading offers unique benefits that can elevate your investing game. With options, you can protect your portfolio against market downturns, essentially creating an insurance policy for your investments. Now, what sets us apart is our commitment to your success. We provide extensive educational content to help you understand options trading inside and out. And with our 24-hour servicing, support is always just a call away. But that's not all. Options also allow you to generate income from your existing positions. Strategies like covered calls let you profit even when your stocks aren't making big moves. Options also shine when the market isn't following a clear direction, whether prices are rising, falling, or staying flat. There's always an option strategy you can use to potentially benefit. Now, we offer two ways to trade options: listed options for US shares, ETFs and futures, and over-the-counter options through spread bets and CFDs. Both types give you the ability to take various market positions. So, ready to explore the potential of options trading? Well, open an account today and take your first steps into this dynamic market. Remember, while options trading can be rewarding, it comes with risks. Always trade within your means and never risk more than you can afford to lose.
Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next shiny new thing. Bring me the next.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Hello and welcome back to Technically Speaking, and this is where I answer your questions with regards to your trades, etc., and where we also look at the trade of the week and the setups and things that we discussed beforehand. So I was just talking about the Australian dollar versus the US dollar on trade of the week, and yes, you may argue, well, no, the trend is still, your friend is still pointing downwards, and you're right, it is. We still have a series of lower highs and lower lows. But as I just said, we did manage to break up the previous highs, the early and the late January highs here at the end of, at the middle of February. So we had here a candlestick close for the first time above these two highs. So for me, that was indicating that the chances were pretty great that we formed a long-term bottoming formation here and that we would be heading back up again. And we did rise a little bit towards 64, But since then, we've come off quite significantly as the US dollar has strengthened once again. But for me, because the risk is pretty small, if we go long here at 62.25, for example, and we have a stop at 60.80, if we are right, and our view is that we could head back up again towards the highs seen perhaps even back in September of last year, so we're talking 68, 69, your potential gain is about, let's say, nearly 400, or let's say 370 points, 75 points or things like that. And your initial risk is much smaller than that. So that's why I'd be interested in setting this sort of trade up. And also because if you look at other currency pairs, like the British pound against the US dollar, let's look at that one. That has already broken through the same pattern, and we see this reversal taking shape here. You can see here we had also the September to January, February downtrend line, and then we managed to break above these January highs. We did so at the beginning of February, mid-February, and since then we've been trading above there. So for me, that uptrend still continues. So what you sometimes do is you look at other markets, you look at the dollar basically against other currency pairs to see whether your view actually could be right, even if on your chart you're still in a downtrend because your chart might be lagging the others. So basically, Australian dollar versus US dollar is lagging the European euro against the US dollar, or for example, the British pound against the US dollar. Now, questions. Options are safer at the moment. Well, that's up to you. I mean, what is safer? Fine. If you buy options, yes, you have the premium. That's the maximum amount you can lose. If you trade on indices, or if you trade or spread bet commodities, or FX or equities, and look at indices, obviously with the volatility that's increased, then you could potentially lose more. That is correct. And also with the uncertainty regarding whether Donald Trump is going to impose 25% tariffs on the US's neighbors tomorrow, on Mexico and Canada, and put an additional 10% tariffs on Chinese imports into the US, that might have a very negative effect on equity markets. So yes, you're right. You could buy options if you want to, and if you feel safer. Or you could also say, well, actually, this increased volatility is giving me more opportunity to make money more quickly. But obviously, you can lose money also more quickly. So what you need to perhaps do is reduce your trading size so that you've got wider stops available to you. And whatever you do, make sure you have stops in your trading platform on your phone already placed if you trade via your phone, because when things go wrong against you, they can happen very quickly at the moment because of the heightened volatility. So that's my answer to that question. Why will you sell that? I don't know what they're talking about here. Sorry, I don't know why will I sell what. Doesn't matter. Let's go to the next question. Right. Is the uptrend finished for SRB? Let's have a look. First of all, you never ever know whether an uptrend is finished or not. I mean, that really, what's SRB? Do you mean RBS? SRB? Because SRB for me is Arabia Gold. Andrew, can you just send me the code or ask the question again and tell me the actual name of this stock that you're looking at, because SRB doesn't bring anything up on the platform. And Adam Deleuze, the DAX is trading in a wide range today. Do you have any reasons as to why this is the case? Well, there's heightened volatility because this morning we opened much higher with a gap on the DAX overnight. And by the way, that was a great opportunity to sell into that gap, which I looked at earlier this morning, but you would have to be up at, I think the signal was at 6:38 in the morning. Yes, that happened because basically on Friday, US markets regained some of their losses over the week, and they basically led to a higher open in Asia. Asian markets also opened higher this morning because there was hope that the meeting yesterday by a lot of the European leaders in London and the proposal of a potential peace deal with Ukraine will now be put forward to US President Donald Trump. All of that led to hope that we could get a peace deal, and therefore equity market sentiment was quite positive. But straight away what happened is after the strong rally in the DAX, and let me just bring the DAX up here early at 8 o'clock in the morning. So this is the daily chart. Let me just go back up to the, let's just look at a 3-minute chart or 5-minute chart. Can you see here? So that was the 637 sell-off. Then we had this rally here at 8 a.m. And then we had a move down, and this was probably sellers into this buying frenzy here, who wanted to basically probably get out of their larger positions ahead of the risk of tomorrow, the tariffs being imposed by Donald Trump, perhaps. And then since then, we've just gradually gone back up again because other people think that he might not do so tomorrow, and therefore buying the market again. So there's a lot of volatility going on because of all these different scenarios playing out. Maybe there's something else happening that I haven't seen yet. But yes, a big differential between buyers and sellers. And by the way, if you look at the FTSE 100, we made a new all-time high today. So here we're heading higher. And I know a lot of people went short the FTSE at the beginning of the year. And then last week, they didn't get out. You had an opportunity to get out. That wasn't a top. Because that is an ABC correction. That's an Elliott wave zigzag correction. And that's actually a huge buy signal here, not a sell signal. So don't think because something is making an all-time high, it can't go any higher and therefore it has to revert. It might do so for a day or two, but the trend's your friend, and that's still pointing higher. So the FTSE is making new all-time already high. So SRB was Serbia gold. So, okay, let's look at this. Let's go back to this one here. When will this top out? Well, I've just told you, if markets make new all-time highs, then there is a reason for that to likely continue. Let me just look at the daily chart of SRB. So what we've seen here is Serabi gold, I should say, not Serbia. Here we've had a bearish engulfing pattern. So that is negative on Thursday. And in the last 2 days, between Thursday and Friday, we've taken out 1, 2, 3, 4, 5 days of gains, even 6 days of gains previously, 6 straight gains of gains. So that is telling you that the top, at least short term, is likely in place now. The question is how far could it go? So what you would probably do is look at your trend line and see whether you're finding support around your trend line. Now, this is a tentative trend line because we've only got 2 touching points. Actually, we've got 3, so we could say this is a proper trend line. Let's just make it a solid line then. Yes, so we're getting close to that trend line. Maybe we're going to bounce off here. For a top to be confirmed longer term, we would have to probably take out the previous highs here and fall all the way through the December low. So that's a long way away, or at least the late January low. But yes, short term, it does look as if this uptrend is at least pausing and may even have short term reverted to the downside because of these negative candles over the last few days. MasterCard. Let's look at MasterCard. The next question. Now, of course, I'm not giving you any trading advice. I'm looking at the charts and interpreting them just by glancing at them. Obviously, if I do proper technical analysis, I would spend an hour on this at least and really look at all the details and everything. But yes, MasterCard, just by glancing at it, what we're seeing is a retest of the previous high from February. We saw a sideways trading range, and the momentum in the last 4 or 5 days has been upward. So it does look to me as if we're breaking out, but we need to see a daily chart close above the late January high for us to confirm this breakout to the upside. And once that is the case, well, obviously we're making new all-time record highs. And what we then would have to do is probably look at Fibonacci extensions from the last relative lows, which are important. So we could do that, for example, from here, from the low seen in 2020. So how do you do a Fibonacci extension? Well, you look at your Fibonacci extension. So let me just try and find that here. Fibonacci. Okay, I haven't looked at Fibonacci extensions on the platform for quite a while, as you can tell. I can't find them on here. So why don't we look at that next time around, and I'll show you how to create a Fibonacci extension. Well, let me just see whether I can have them here. Here they are. So you take an important low, and you can see here you had 2 monthly candles going down against the trend. So that is an important low. You take that distance, project it to the highest point here of that next move, and then from the highest point down, you go to the lowest point before the market continued its uptrend, and that gives you your Fibonacci extension targets. So let's just do it again. So what we do is Fibonacci extension, lowest point, highest point, and then from that up move, the corrective move down before the trend continues here to new highs, and you just put it on there, and then you get these Fibonacci extensions. So what are the extensions we've got? 161.8, that's the target for MasterCard, the next one, and that one comes in on the spread bet at 60,257. So that's the next upside target for MasterCard on a monthly basis. If we were to close on a daily chart basis today or maybe this week above the January 30th high. So this is how you would analyze this sort of breakout here. So let's look at LGen, another question. I like it when questions come in like this. Keep them coming. So legal in general, what we can see here is basically we had a spike higher at the beginning of February. Since then, we've been trading sideways. You can see this ABC corrective pattern again. I just showed you on the FTSE 100. So we go down, up, down. It's sort of a zigzag correction. You can see it again here. You saw it in December. And I trade this pattern personally, actually. It's only right about half the time. But because the reward potentially is much bigger than the risk, it really works out well. So for example, here, can you see you went down from a high, back up again, down again, and then you held here at support. So what do you do? How would I have traded it? I didn't, by the way, but how would I have done it? Well, I would have waited for a buy signal. What's a buy signal? Here you can see you had a harami, an inside bar, if you looked at the candlestick. And basically on the next day, once you break out of that inside pattern, after this ABC correction, you go long here, you stop as the last low. So that's your tight stop. And you can see here, your potential reward is 4 or 5 times greater. So how would you trade it here? So same thing again. You would have gone long on the break, not just on the close, but on the break on Tuesday of last week with a stop loss down here. And you could have had another entry opportunity here on Friday when we went down on the share price to 240-ish, and right now you're long. Now, would you go long now? No, because your stop is too far away, unless you expect a new high to be made, in which case you can see here the distance probably 2 times what your initial risk is. In that case, it might make sense. But yes, because of that hammer formation, if you want to go long, I would only do so once you break above last week's highs, just to confirm that you're actually breaking higher. And then if you wanted to have a tight stop, you would take Thursday's low. If you wanted to have a wider stop, you would have the low from the 24th of February, last Monday, in place here, with an upside target being the February high, and then longer term, also higher highs. But you can see here that the high seen in February was only intraday above these key resistance areas here, made up of the January highs, and they might act as really strong resistance going forward on a daily chart closing basis if we continue on the current upward trajectory. But at the moment, as you can see, we're trading a big sideways trading pattern. Short term, we're trading upwards. Since last week, we had our first bullish week in 4 weeks. In 4 weeks, and this is likely to continue in the short term, at least, just eyeballing the chart here. Gold is the next question. So let's have a look at gold. Well, spot gold, we made all-time record highs, and we did so on this uncertainty. And also, you saw probably President Zelensky at the White House and what happened there. So that led to quite a lot of volatility. And Donald Trump's comments anyway do so all the time, and his posts on True Social as well. And you can see here the gold price has currently come off its record high, which was made around $2,950 per troy ounce last week. You do know that my upside target, and I've been saying this for years now, is 3,000. That's the first one. It's just below 3,000. That's the Fibonacci extension. I've got another one at 3,100, but I wouldn't be surprised if we're around the 3,000 mark, because it's such an important round number that everybody can talk about. And remember that we might actually, short term at least, struggle around there. So what we've seen is a bearish engulfing pattern here. Short term, that's bearish. So yes, we may come off a slightly further, perhaps retest the October high here on the weekly chart that I'm looking at the moment, and that was made at 2,790. That should offer pretty good support. If you go to the daily chart, what we see here is that we've fallen through our uptrend line, which goes back to the beginning of the year. We are currently flirting with the 30-day simple moving average here, and we are holding above last week's on Friday's low at $2,833 per troy ounce. So right now, perhaps some consolidation and sideways trading being seen here with regards to the gold price. But as I said, if we were to fall further, the October high here should really offer pretty good support going forward. Now, somebody says technical trading won't work for a while anymore. Well, I don't know. All I can tell you is my own experience. And basically, I've been doing this for over 30 years. I've traded my own money for over 30 years. And, well, I'm doing pretty well. So all I can say is that if you don't believe in it, don't use it. You know, look at fundamental trading, look at macroeconomic events trading, look at flow trading, whatever works for you. You don't have to trade technically. Some people prefer to do so. I prefer to do so because I can see very clearly where I'm wrong on the chart and can do so very, very quickly intraday, which you can't really do fundamentally speaking. But it's up to you, really. You don't have to believe in it. Yeah, what else can I say to that? Okay, what else can I see here? No, these are all the questions I've had. Please send in any other ones if you're interested in that. What else can we talk about today? Well, we saw all the defense stocks after yesterday's European leaders meeting in London go up. So let's look at, for example, Rheinmetall in Germany, and you can see here that they've rallied very nicely. Sorry. Yeah, spelling mistake. If I can't even spell something German, that's not looking good, is it? Rheinmetall. So here, can you see this huge gap higher? Huge up move in Rheinmetall, up 11%. So yes, and we saw that on a lot of other defense stocks as well. BAE Systems, I think, also up. And you know, people always say to me, "Yeah, but the charts. Can I see this sort of thing beforehand?" Well, no. Obviously, it's dependent on the data. Can you see here BAE Systems? I think that share price was up earlier today, about 16%. That's up 13%. So all these gaps. But before these gaps happened today, what did we know? Well, look at the market. I mean, we were forming these reversal patterns to the upside. We were bullish over the last few days. So the trend was already pointing towards higher prices being seen. The question is, what do you do now? Do you expect this price gap to be closed? Or do you expect basically the market to just continue to go higher? Now, with stocks, usually when you've got a big gap like that, well, the trend tends to continue, but if it's that big, maybe we will retrace some of that gap and close some of that gap before we go higher. But you can see Rheinmetall trading here in all-time record highs, so looking very, very bullish indeed. MSI, so let's look at MSI, another question. MSI International, here we go. We've got 2 minutes left, and what can we see here? The pattern I just told you about, ABC correction on the monthly chart. So down, up, down. Now, do you want to trade on the monthly chart? Probably not, because if you were to, you would buy now here and put your stop below the February low and hope that the pattern is correct, in which case you should make a new high above the high, the all-time high seen here, I believe, in July of last year. But let's look at the shorter term time frames, because I don't think anybody's trading on the monthly chart. And on the daily chart, you can see here that we are nicely heading up today. We're trying to close above this previous January high. If we do so, we would be forming a reversal pattern here. So you could basically put your stop below the February low. And in that case, if it is indeed a reversal, the next upside target is this high here going back to mid-November. That would be the next upside target together with the July high from last year. But you can see here we have already today, and are very likely to close above that also, broken through our our trend line. That is not the right trend line. Sorry. Let me just delete this and put a proper one in. So from that high through this side, that's a tentative trend line. So let's just make it a dashed line, 2 points only, and we're breaking through that. So that's all looking pretty bullish in the short term. that's for today. Technically speaking, I hope I showed you some chart patterns, some way of looking at charts. Obviously, only use them if you're interested in them. If you don't believe in charts, don't use them. Do something else. Do whatever works. But whatever you do, always use a stop loss. Ideally, make it a guaranteed stop loss, and make sure that you don't overtrade with regards to your size. Don't trade 5 or 10% of your capital per trade, because at some times you've got to go bust. And also make sure that your average profits are greater than your average losses. Good luck. Goodbye.
We are back. This is Overtime. I'm Ilya Spivak from San Francisco. That's Dylan Radigan from an undisclosed location somewhere in Western Europe. Sir, what a day to have you reporting from the front lines.
Well, let's calm down about the front lines. I would like to understand your pleasures. What is it about this stock chart that causes you to feel so satisfied? And what is it that has caused Chris Vecchio to feel he can't even attend a discussion like this?
I will say with great confidence, first and foremost, that Chris is not absent here for lack of a desire at a sparring match.
Okay.
I fully expect that he will be back to tell me all the ways that I am wrong tomorrow. But what I like about this is that every piece of the narrative that I've been looking for, and not just the stocks piece, the dollar piece, the bonds piece, all of which is working today, but the reasoning for it, that the thing that we're concerned about, the thing that's motivating these moves, is a concern about economic growth. I think that's really why I feel satisfied for now. And anytime things start working, I get immediately concerned that I'm going to overstay my welcome. So I'll take this one day's close with heart, but I'm going to be annoyed already tomorrow, thinking if I should maybe not overcount my chickens.
In the Spivak scheme of nibbling on directional momentum,
yes,
and I would say with the backing of legitimately questionable economic data over the past 30 days in terms of all the things that you've cited, why not be a little bit more? I mean, like, listen, 1.5% is not catastrophic in anybody's world, but it's not nothing. And it is a clear directional point of view.
Yes.
Why not take this 1.5% as the beginning of a large? Not to mention, look, I mean, you have the chart there. Look at the last whatever it is, 5 or 10 days. Look at the rhetorical reality, meaning, the Trump saber rattling, the sort of White House somewhat, the sort of low class kind of vibes in the White House, if you will, meaning public yelling and screaming, sort of not. I mean, odd coming from me as somebody who became internet famous for yelling and screaming on MSNBC, but still, it's,
alas, you were not the president nor the vice president of the United States at the time.
Not even close. Not even close. Anyway, I not to make you talk against yourself, but you've got negative momentum and you've got a negative day. I'm more, as a cautious equity player, I wouldn't even say as a cautious bear, happy to be short oil, happy to be long the bond, but had a hell of a time in equities any which way you want to call it personally. Like, why would I not feel more confident with a short equities position at this particular moment?
I think you should feel more confident with having one. I think you want to be cautious about initiating one. And what I have here on the chart is the continuous contract for ES futures, just so we can see kind of the full breadth of what's going on. Obviously, we've talked at length about the story basically from early to mid-December being, here's the range, this was a rally from August into that high. Obviously, this was a move higher. This is now a move sideways. So something changed here in markets where we set this high. We had a bunch of shocks along the way, be it tariffs over here, DeepSeek over here. That's kind of spooked us, but nothing about this structure was suggesting that the market had particular confidence to go any which way. But anytime you'd get up here, the risk reward seemed fairly good to bet on the downside. And so that's what I've done, because if you're wrong fast. You just get up here and that's it. And if you're right, you have more room even if you stay within the range. So what's worked for me in this particular sense has been the move down into the range bottom. And now we have to see, because selling it right here implies that you've assumed this is going to break down, but you don't know that. It held here, it held here, and here, and here. So I would say at this point, your risk reward isn't attractive to get short until you take out the bottom of that range, because nothing is to say it's not going to bounce again. Meanwhile, you have a lot more room to go this way if you hold than to go this way unless you break. But if you break, then absolutely I would be looking, in my case, to increase the size of my short. And if I wasn't short already, I'd be getting in. It's a much more ominous story looking at the NASDAQ. And here, I mean, this is just... Would you
originate a new short position on this NASDAQ chart?
For me, it would be really this line in the sand now. But yes, I would be open. I would be open to looking at buying a put vertical here. I think if we look at the IV readings, there's a little bit of IV here. I don't necessarily think there's very much you can do about that other than just assume that's going to impact the pricing of these options. If you wanted to do it via ETFs and the Qs, you're looking at basically the same thing. I do think that you can very clearly see it in the Qs, as a matter of fact. This now looks more like a breakout. And
in the negative sense.
In the negative sense. So if this was the bottom of your range right here, I mean, from a technical perspective, this is about as clean as it happens. You come in, you test the prior low, you bounce off it, and then you get conviction. Boom. That's a breakdown. So if I was going to take a short and I was going to activate it now, it'd be here. Now, I'm already short. I've been short, and so I'm just going to keep holding it here. I'm not going to quite add at this point, but if I wasn't already in this, I would be originating. The other one is the Russell, and this one looks pretty awful also. Let's look at the continuous contract here so that we can get some more data. There we go. I mean, clearly, this is another one of those that looks like it has follow through on the downside. I might be a little bit more reluctant to take this short now that we're kind of in this congestion area here where we've been stuck before. NASDAQ, though, I think is something, if I didn't have on, I would get on.
Meaning you'd be comfortable originating a new short NASDAQ position tomorrow morning.
Yes. And I mean, if you really wanted to, if it was really burning a hole in your pocket and you absolutely had to do it, you can do it overnight. The NQ futures are there. MNQ futures are the smaller micro version of the contract. You are going to need to lay out some more margin to do this overnight, and liquidity is going to be thin. So getting fills is going to be a bit dicey. But that's if you didn't want to wait to do it at the open. But that's something I would look at. Yeah, I think looking at NASDAQ here makes sense.
How about all the layers, meaning long bond, short dollar? Like would you get into the full sort of risk off posture from here?
So I've been long the bonds, and that's working. I think at this point, when you start looking at the long end, you really have to pick and choose. So if you're at the long end here for ZB, I think this is, of course, the 30-year, you're kind of starting to get into a dicey risk-reward thing. There does seem to be some kind of a something right here, and you're very close to it. So I'm not sure that I would chase this right at this moment. If you go down to the 10-year, you can really see it very clear cut. So against this high, I would want to see either a break or a pullback. So if we got to here, yeah, I'm long.
Mm-hmm.
And I'm initiating longs if I don't have them. Here, you're kind of nose... Yeah, you kind of nose up against it here. So I would either look for this to pull back, maybe somewhere into here. I think the more interesting sort of things occurring, if you wanted to essentially say we're going into a risk-off kind of broad growth concern type of world, I'd start looking at currencies. And here, I think stranger things have happened, but the euro actually looks very interesting. We're basically, at this point, we've erased all of this big sell-off, and we're right back to sort of the starting line of where this range has been holding. If we can get a little close-up here, that's something to look at. The Aussie or the Canadian dollar are probably tougher to justify if this is a growth scare. They don't tend to do well in a growth scare, but I still have these longs basically looking for this bottom or whatever this attempted bottoming here is to hold. So I have that on. I have the Canadian dollar on for the same reasons. I might regret that Canadian dollar one, though, because it does seem to be especially soggy today, because apparently we might get tariffs tomorrow. Those ones that got ostensibly shelved. The Commerce Secretary, one Howard Lutnick, was out today talking about, yes, they're going forward, but we're not going to tell you how much we're going to go with because that's being negotiated. Now, what exactly is being negotiated between today and tomorrow when these things are supposed to go into effect? And can you negotiate down to zero and still say it's going forward? I don't know.
I mean, but do you even think it's going to happen? I guess that's the question, because it goes to sort of my conceptual, it's like my version of the short oil on threats of World War III is, long everything on threats of tariffs, and certainly long Canadian dollar. I mean, and the other side of everything that you just said to play the role of Chris Vecchio is, if you don't buy this dip, what dip wouldn't you buy? That this is that this is the same as every other dip the last decade, and no one has lost money buying dips in this town or in this country, and it's no different this time. And whether it is or it is not, at the very least, we know that tariffs are saber rattling; they're not reality, and so buy the Canadian dollar would be the.
Well, this is where and to this end, I'm holding it long still. And
you're long the Canadian dollar.
I'm long the Canadian dollar. I'm long the Australian dollar. I'm long the euro. I'm long the pound. I'm short U.S. dollars across the board.
Okay.
And for me, it's a yields thing. There's this thing that the dollar does. The economists and hedge fund manager Stephen Jen famously coined the dollar smile, which was this relationship that relates the dollar to how well the U.S. economy is doing relative to kind of major G7 economies. And says when the U.S. economy outperforms, when it's stronger than everybody else, the dollar obviously outperforms, higher rates, more yields on dollars, more positive story, money going to dollar-based assets. All of that is very kind of obvious. In a horrid, the U.S. is aggressively underperforming environment, the dollar does well again, which kind of gives you that smile structure.
Yeah, I remember this.
And that's because of liquidation. The dollar is the most liquid currency. If the U.S. economy is in trouble, it's the world's largest. Everybody freaks out because they think that a U.S. cold will be inherently contagious because of how bad the U.S. economy is needed for demand everywhere. And so you very much got this lesson in 2008, right? It was our mortgage crisis. Everything fell. The dollar rallied because that was just the cash out venue of choice.
Mm-hmm.
Because of its unrivaled
But the
liquidity.
middle of the smile is that it's not so bad that we need to abandon all hope, but it's not so good that the dollar, that your suggestion is we're in that sort of middle, that we're in the slouchy part of the smile.
And we're traveling. So between the U.S. outperformance side of the smile and the, oh my God, global recession side of the smile, there is a travel as the U.S. economy slows. And we're seeing it slow now. And in the travel is the repricing of Fed policy expectations to something more dovish, which of course we've seen, hence what's going on in the bonds. And I'll bring up the 3-month SOFR here just to give a sense. And we'll go to the Z4 contract, so end of, or Z5 contract, end of this year. I mean, we can clearly see interest rate expectations are falling. So this is much the same relationship as you would expect bond prices and bond yields. The price is going higher, so the implied rate is going lower. The way you'd get there is 100 minus this quote, 96.32. So what this is telling you is that interest rates by the end of this year are getting marked down, starting from shock of shocks, February the 21st, which is the day you get that awful PMI data a week from last Friday. So it's very clear. The market is saying, okay, the environment is getting worse for growth. The Fed is going to have to get more dovish. I think ultimately that's bad for the dollar until you kind of get fever pitch liquidation, and there is a period of time there. There's a handoff.
And so, like, just looking, I don't know if you look at what. So, if you were to say the well-being of the dollar is reflected most in the dollar-euro position, the dollar-yen position, or in a DXY basket. In other words, the health of the dollar is best evaluated by what metric? Is my first question.
I think DXY is basically just the euro upside down, because that basket was made before there was a euro. And so it's made up of a bunch of legacy currencies that are now the euro. So the euro is a giant part of that average that skews it heavily. And so DXY basically is the euro. So it's kind of...
But is the dollar-euro relationship
irrelevant.
The best referendum on dollar sentiment?
I think euro... I think you look at three things, basically. You look at the euro, you look at the yen, and you look at the Aussie. The Aussie is your window on China. That's another thing, by the way, that's not in DXY. There's no reflection of the centrality of China in the world we live in now. But I think you look at the Australian dollar as a sense of how worried are we about global growth and global recession writ large. It's sort of the risk on the stock market of currencies. Largely because, of course, it's Australia, it's a commodities producer, it's at the front end of the supply chain. If there's a cyclical concern, it shows up there first. So there's that. Then I think you obviously look at the euro for sort of overall dollar direction, the most liquid, the biggest kind of indication. And then for a pure look at yields, there's the yen. notice the yen has done a lot better against the dollar than some of these other currencies, because there's no tariff conversation about Japan, and it's just pure yields, and yields have been falling. And when yields fall, the yen tends to do better. And this is just the carry unwind in reverse. It makes sense to borrow cheap yen and buy higher yielding things if rates are going up. If rates are not going up, then those yield differentials aren't expanding, they're narrowing. They don't make sense. And so people start to unwind that kind of exposure and buy back yen.
Do you actually think the U.S. economy is slowing down, or do you simply think that the sentiment about the U.S. economy is more clouded due to mixed data and sort of political, rhetorical reverberation? In other words, how much of this is really just, okay, a couple of wacky numbers and a wacky president, but I'm still kind of perplexed as to why I shouldn't go to the millennial knee jerk of buy the dip. The dollar's going to come back, the Nasdaq's going to come back, that this is basically, we've seen this movie 1,000 times, and this is just episode 1001.
Unfortunately, all of these things appear to be connected. So if you start to read what is actually being said in the PMI surveys, in the consumer confidence surveys, and then what is showing up in CPI, in PCE, you're starting to see the wrong kind of stuff. So the surveys will tell you businesses are retrenching and that uncertainty about the fiscal environment and tariffs is a big reason why. The consumer confidence surveys, whether you ask the University of Michigan, that's one big one. You ask the Conference Board, that's another big one. You ask them why consumers are unhappy all of a sudden. And again, it's uncertainty about fiscal policy and uncertainty about tariffs. So on one side you go, well, this is just sentiment. Let's not get overly concerned. These are the first few months of this new administration. People are getting acclimated to how rapidly all of this is coming at them. They're understandably shaken, but once sentiment kind of evens out and they acclimate, everything will be okay. Except for when people start not spending and not investing because of uncertainty, it doesn't really matter because they're not spending and they're not investing.
Right, well, it becomes self-fulfilling. That's the whole
It becomes self-fulfilling. And so when against that backdrop, you start to see weakness in hard data, which you are now seeing, you get a weak retail sales report most recently, the CPI and PCE numbers tell you that inflation pressure is weakening in the service sector, which is the last place you want to see that happen. That tells you demand in the one spot where you can't lose it is weakening. So, and of course, all of the models, even the Atlanta Fed GDP model that everybody likes to follow, which inputs data as it comes out and sort of updates GDP expectations in real time, it's collapsed. Absolutely collapsed. So all of the kind of tangential inbound data has really stoked growth expectations. And if people then look at this and go, well, this is just too chaotic. It's not that I know or don't know where things are going. I don't want to play the game. I don't want to lay out money to build a new factory or hire more people or buy a car or buy a house in this environment because I'm uncertain. I'm just going to hold my money and wait and see.
About just
that's
being
self-fulfilling.
No, and I guess my question for you is, where in the data is the evidence of business owners making the marginal decision to either withhold or redirect in the way that would be sort of feared in a situation like this? Or is that
the PMIs are the PMIs are the, yeah, I mean, that's a survey of purchasing managers. So those people at large corporations whose job it is to know with good confidence what demand is going to be in 6, 9, 12 months, and on that basis to figure out inventories, to figure out staffing levels, to figure out what's doable and what isn't. These are the perfect people to ask. Their job is to think ahead and forecast. So you look at what that latest February PMI numbers gave you, and they were a continuation of January, which was weak already. And it's a very ominous song because you have the first contraction in service sector economic activity in 25 months. And it's because everybody collectively decided, you know what, I'm going to keep this money in the mattress. It's fine over there. I don't want to risk setting it on fire out here. And so there's been a kind of retrenchment, and everybody that's being polled is singing this song. And then you turn over, and consumers in 2 separate surveys, they're singing the same song. So you start to see consistency, and then you start to see hard numbers. Oh, consumers are unhappy? Oh, well, there's a weak retail sales number. They really are. They're not just saying it, etc.
I mean, I guess, but if the economy really is going to slow down the way that it might slow down in the context of all the reasons why it might slow down, then the market's going to go a lot lower than this.
Yes.
Like, we're nowhere near. This is just a moment of like concern in the face of, the potential for a slowdown.
Yes. I mean, if we extrapolate, let's say that this level breaks in ES, just to kind of benchmark ourselves a little. So this right here is what, about 6160, and this right here is about 5860, let's say. So we're talking about, let's call it about a 300-point swing here. That would take us, if we were to just do really kind of basic technical analysis here, the usual implication is to say, okay, if this is some sort of a top, and this is the neckline on confirmation. So if you break this range, then indeed this is a top. You've rounded one. Now here already you're in a sell-off. Typically what you would do is you would extrapolate down and say there'll be a move this way equivalent to what this distance is as a kind of rough guesstimate. And so if you have about a 300-point move from here, you're looking at what, like here somewhere? And obviously that's already a big move, and a move through these former highs that held in July and in August. So you push through this right here. You do that, and you might be back to August lows before long. And now you're looking at a real meaningful sell-off. I mean, look at the sector breakdown today, and it's pretty ominous. There were 4 sectors that did okay today against the backdrop of this aggressive selling everywhere. Consumer staples, healthcare, utilities, and real estate. How much more defensive does this get? All of the hotness is down. Tech down 3%. Anything financials down 0.8%. Anything cyclical, energy down 3.5%, materials down 2%, industrials down 1.4%. If it's tech or it's growth, it's bleeding out today. And if it's defensive, it's up a hair. So all of this smells very growth concern-ish. But if, to your point, we've learned that cabinet ministers saying things don't necessarily mean that those things are what they are, because then the president is going to come out and say, no, actually, it's something else. That Lutnick came out earlier and said the tariffs are on by no means suggests they are in fact on. This would not be the first time that a cabinet minister is overruled in the 11th hour. In fact, we just saw this happen with all kinds of topics just in the past week, where a cabinet minister comes out and goes, hey, no tariffs till April. No, tariffs are on. Hey, we're going to have a mineral deal. No, we're not. So all kinds of things are in motion here, and maybe we don't get tariffs suddenly when the market's open tomorrow.
No, I mean,
and if
that's
we
why
don't,
the sort of the contrarian thing would be to buy this entire dip on a snapback. Super glide, AI lives. You know, Trump basically is full of shit. And so there won't be tariffs. Like this is just a reality TV show, but the financial reality is unchanged.
I wonder if the contrarian thing to do here, given people's tendency to want to buy dips, is actually to say, well, no, this time it's different.
This one is real.
This one's real. Because, and this is what I was saying at the top of the show. It's one thing to get some headline and then to go, well, how many times have we seen this become a nothing burger? It's good for 1 day, 2 days of selling. This was the whole story of last year. My bearish frustration with last year was you get a little baby sell-off and you go, oh, okay, well, finally, here we go, sanity. And then you go, no, that was just a few days there. No, we're going to buy the dip. If something really cracks, there's probably a bunch of people that are going to suddenly realize you can't always do that. And there's a really big mass of them out there. And they're thinking, buy the dip. And when it overruns them, they're going to have to capitulate, which means it's going to have to be hard on the way down. We could, in fact, be looking at a very, very large sell-off.
Well, I almost feel like it's like I don't know what the odds are, but I would say it's a 1 in 20 or a 1 in 50 chance of an abominable sell-off. Catastrophic.
Yeah. One thing that maybe prevents it this week.
Still, go ahead.
No, to your point, I think the market doesn't want it. I don't think the market wants a big sell-off. It just might have to have one. And something that maybe prevents it, maybe holds it up this week, is the absolutely ridiculous economic calendar. I mean, every day there is something big this week. There's the National People's Congress in China. There's jobs data. Powell is speaking. There's more U.S. growth data. There's the tariffs, which maybe are going to happen, maybe aren't. There's all manner of macro risk. And if you're a trader, you're sitting at the bottom of the range here, maybe what you're thinking is, you know what, I'm not going to commit one way or another here. I'm not going to say that ahead of NFP and ahead of Powell speaking on the same day, I'm going to know that this thing is going to fall. I'm going to wait and see what that is. And then I'm going to know, or think I know. And so in the meantime, that might actually anchor this market a little, because people don't want to make a directional bet ahead of all of that event risk.
If you wanted to get short the U.S. stock market, you would do it with the NASDAQ?
Yes, I would. I think the price action is telling you here that if you wanted to take a trade, this would be the place you'd do it. And if you wanted to say, you know what, I'm not prepared to pull the trigger, I think there's not going to be conviction in this move. I think we might back up into here somewhere before the real cascade comes. I would understand that logic. Thankfully, I don't have to think about it that way, because I have a short on from up here. And so I'm okay holding it and waiting it out. But I think if you were going to be a seller, NASDAQ is where you do it. I mean, this is a flimsy level that, frankly, barely merits thinking about. I think really this is it right here. Whatever low was here has clearly been tested. Market acknowledged it. It said, yes, I know there was a level of significance here. I hear you. I'll try. And then the answer was not good enough. Goodbye.
Mm-hmm.
So if you're going to be a seller, I think that's where it's done. I don't see China's National People Congress helping the NASDAQ particularly here, by the way. If it's going to help something, it's probably not going to help NASDAQ. Because if NASDAQ is a referendum on US AI and the rubber stamp legislature comes out and goes, hear ye, the deficit target is now higher, we're going to spend more money, and our new 5-year plan kicking off next year is going to be more about building out our tech scene and bringing in Jack Ma from the cold and everybody else and nurturing our AI space, then of all things, I mean, maybe that's good for China and linked assets, but it's probably not good for NASDAQ.
Mm-hmm. It's very hard for me not to buy them. Only because I feel like it's a 1 in 50 chance of a catastrophic sell-off and a 1 in 2 chance of, the 1,001st, you don't get a sell-off without real fear.
Mm-hmm.
There's lots of good reasons for real fear. We've also had real fear a bajillion times at this point, and nobody cares.
I think that is actually music to my bearish ears, because the more people think this way, and I think a lot of people do, and with very good reason, let's be clear, with very good reason. This market has had all kinds of reasons to freak out, and it hasn't. It's been incredibly resilient. But
remarkable.
Incredibly, in the face of what are just a sea of potential landmines.
Never ending.
This market has brushed it all off. I think now the situation is different because it's finally come for economic growth. I think you can paper over all manner of things if you have growth, but if you don't, you can't. Because people get fundamentally defensive about spending, they retrench, and they get risk averse because without growth, money tomorrow is not nearly as easily envisioned after losing money today. So you're going to try not to lose money today. You're going to try to say, you know what, I'm more uncertain about the environment. I'm not going to risk it right now. I'm going to be much more circumspect about what I do, because if I lose this money, be it on an investment or on a large purchase of some kind, or growing a business or starting a business, whatever it is, if I make an outlay now and put money at risk, and the sum of all fears really does come together, and growth slows, at best it'll be a long time until I get that money back. And maybe I'll need it, and then I'm upside down in an economic downturn. So why don't I just hold off here and wait? I mean, one very telling thing about last week is they didn't just come for stocks. They didn't just buy bonds. They came for things like gold, which you shouldn't expect to weaken in an environment where yields are going down. But it looked like they were just selling anything they could sell and make into cash. That's not the kind of liquidation dynamic that you want to see if you're a buy the dip enthusiast.
But you can't have a dip if you don't have a good reason for the dip. The dip is where you buy them. You see what I'm saying? Like,
sure.
Like a dip for no reason is no dip.
I agree. It's just a question of how deeply do you dip? And my sense is you could dip a lot lower than this.
I mean, if it was not for recent history, I couldn't agree with you more. There's a billion logical reasons for the market to get shellacked. You know, starting and ending with the absurdity of the American president, compounded by the, how do I even describe it, the catatonic state of the European economy.
Yeah.
The corrupt nature of the Russian non-existent, a mafia economy, and the busted nature of the Chinese economy. So the only story I can tell you is technological superglide saves everyone.
I mean, that's certainly the hope.
That's the only story that's available.
That becomes the hope. And when you see the NASDAQ having the conviction to break down here like this, even as you look at the S&P, it's not doing that. I mean, if we even look at Dow here, doesn't have quite the conviction to fully break down. But NASDAQ does. Again, Russell, this is not what you'd want to see from a growth-sensitive small cap index, but it's going down aggressively, maybe not quite getting through some of these critical inflection zones here, but nevertheless, ugly tape action. You start to worry if there is now a kind of negative feedback loop. And if NASDAQ, of all things, can't make hay of it, that's not encouraging. You'd think, what did well when the global economy was basically turned off? So we got COVID, everybody got locked in across all the major areas of global demand. The global economy got basically shut down for the most part. But tech did well because you didn't have to go anywhere. You could buy it sitting at home in your
it was to
pajamas.
tech's advantage, actually. It consolidated.
It ended up being to tech's advantage.
Yeah.
Exactly. If NASDAQ can't make hay of this growth scare, and it's not so far, that should concern us. Now, maybe we still shrug it off. I'm not saying that we're sort of ready to pour gasoline on ourselves and set ourselves on fire, but that this is what's going on, and this kind of mix of catalysts it seems to be finally the kind of thing where if you don't have growth, you can't shrug it off. And finally, there is a hit to growth. And I think that's what makes this particularly scary. Europe is actually...
You're saying the hit to growth is the American tariff saber rattling / uncertainty about future policy.
That's what the PMIs and the other surveys seem to suggest. And it could have been other things. I mean, one of the things that, of course, we've been talking about was the refinance risk. That essentially what made this episode, this kind of post-COVID episode for U.S. corporates, such a different thing was every other time the Fed went and raised rates a bunch because they were concerned about inflation, U.S. corporates, shock of shocks, had to pay more to service debt. Well, yeah, that's what happens. Borrowing costs go up. You have to pay more to service your debt. That's happened every single time except this time. And the reason it didn't happen this time was because during COVID, money was so cheap and corporates were doing so little and spending so little money because there was nothing to do with everything closed that they hoarded massive amounts of money. So when the Fed hiked rates in 2022, they didn't have to go out there and go, oh man, we're going to have to go out there and finance things at these higher rates. No, they had a giant cash stash. But that giant cash stash rolls over this year and next. So now you will have to, with some delay, see interest rates on U.S. corporates go 3 times, 4 times, 5 times in some cases, depending on where the debt was originated, higher. So my concern wasn't really that the tariffs were going to create this level of uncertainty. I think all of us are a little bit surprised at the velocity of what's going on relative to even the first Trump administration. My concern was you only have the U.S. service sector as a growth industry in the world right now, and then you jack up interest rates on it with a 5-year delay, and that's going to give you a growth hit.
Well, it consolidates your only bet to tech.
Yes,
right? It's the any traditional economic analysis tells you reduced activity.
Yes,
whether it's higher rates, whether it's more uncertainty, whether it's inflation, whatever. And so the only thing that overwhelms higher rates or higher uncertainty is, technological revolution.
That
right?
We're going to grow out of it, basically.
Yeah, that there's so much new activity, and so it's such a high level of velocity. I would say that sort of because it's easy to make peace as a non-Trumpist with some of the Trump-ish things where you're like, oh well, there's something to be said for government waste and dealing with that, or there's something to be said for. But when they lay out like, oh, we're going to borrow a bunch of money to buy unlimited supplies of idiotic cryptocurrencies, you're like, hang on a second, this is a fucking clown show. And I feel like this, and so it becomes which is what you kind of in your heart, you're like, I'm afraid this is a clown show. And then you're like, oh, maybe it's not a clown show. Like maybe they'll get, maybe they won't do the tariffs as irrationally, maybe whatever. But then the other side of that is maybe this is a fucking clown show.
Well, and I think if the markets were, and this is why I think they were optimistic about the Trump administration coming in for a round 2 after the election. If you thought, there's this veneer of show, but behind it is a very Republican classic kind of thing. We're going to get some deregulation. Sure. We're going to get some worries about the deficit and some spending cuts. Taxes are going to come down. Okay, we know this. This is generally a pro-growth mix. And even if it came with the tariffs, and the markets knew what the tariffs were, when they're coming, who they're hitting, what the objective is, what the reaction function is going to be for, if China does X, the tariffs will be Y. If Canada and Mexico don't renegotiate USMCA.
Some degree of predictability.
Yes. I think the thing that the markets are having such a big issue with is the elevated heart rate monitor of policy, where
the clown show.
There is no trend, there's just volatility.
I mean, not to bring, I don't mean to focus on it particularly, but for example, I don't disagree with the Trump administration's, and again, take this or leave this, but I don't disagree entirely with the Trump administration's point of view relative to the United States relationship with Ukraine and the war in Russia. I do disagree with any American president having a public shouting match like a jackass in public on any topic, let alone a topic of military conflict. If you want to have a shouting match with another foreign leader, whoever he or she may be, please do it in private. But please have the sophistication to understand that when you are in public, that the culture of decision-making is dictated by the most powerful person in the room. And in this case, that is always going to be the president of the United States. Mm-hmm. And if the president of the United States abandons basic public decorum in favor of, idiocy, and I don't want to choose a bunch of adjectives, but I do think that factors into this, where it's like, okay, this is not a professional organization, meaning the U.S. government is not a professional organization. It's a ketamine-doped multi-billionaire and a reality TV host. And as much as we want to believe this is a new take on a traditional Republican administration, the longer we gander upon it, the less and less it feels like it, which elevates net uncertainty, which gives you good basis to sell stocks, buy bonds, and short the dollar until somebody tells you otherwise. And short oil, for that matter.
And short oil is actually a great other sort of reflection of what's going on here. I mean, to the extent that these are growth concerns,
exactly.
The price action in oil certainly makes sense. I mean, I think you've hit the nail on the head here. It's not that you can love or hate this or that policy. The markets ultimately don't care what the policy is as long as they can benchmark for it, discount it, and be ready. And the same thing can be said for
and have a mechanism
businesses.
of professionalism and predictability from the leadership of the organization.
Well, right, and therein the forecastability goes. I mean, if you look at this whole thing and you say, wait, this is not there is not an even keel, and we really can't. Never mind benchmark what these policies will do. We don't know what the policies will be. And we don't know how quickly they might be and then not be and then be again. And so if it's our money on the line with this volatility, we'd rather not. We'd rather just keep the money and wait and see. It's not a referendum on what the president does in this sphere or that sphere, or what the ultimate policy outcome is going to be. It's that if you're not looking at a situation with enough certainty to make business outlays, you're not going to make them.
And I mean, I just see it very clearly especially from a European, people like to hate on Europe, but there are 500 million people in this continent, more than there are in America. Disorganized, sure, different languages, sure. It's a lot of people. Yeah. And it's a relatively high net worth universe. High tax, yes. High regulation, yes. But it's a lot of people with a relatively high average amount of money who want to like America, by the way.
Yes.
Who are predisposed culturally to be pro-America. And the number of institutions and individuals on the margin that are redirecting business spending and tourist spending away from America is at the highest level I've ever seen.
Well, yeah, I mean, if you thought that you were going to, for example, begin to sell your wares in the U.S. where previously you didn't, you might not go launch that kind of a venture now. You might say, what, I'll see you.
You're going to open a Chicago store today? Why? An LA store
Why not wait
today?
and see?
Dallas,
who knows?
Miami, who needs it?
Yeah. It's just, and again, not because you agree or disagree, but because you just don't know.
No idea.
Yeah, I mean, one of the more interesting things here, just speaking of Europe, one of the places you do get explosive strength today is natural gas. Because ostensibly, and this sort of seems to jive with the surge we've seen in the euro, if this is the vibe that we're going to get on U.S. support for Ukraine, and we heard this from the summit that Zelensky had in London with Keir Starmer and the other European leaders, they're going to have to pony up a bunch more money to retool themselves militarily and to boost Ukraine and fill the U.S. gap. So, or attempt to. And that might just be the thing that shakes the cobwebs of the Eurozone economy.
Meaning development of a fourth sphere of influence. It's not a China, not a Russia, not a North America, but as a separate sphere of influence.
As a kind of return to form, yeah.
We shall see. Anyway, I like short the NASDAQ, short oil going into tomorrow morning.
As do I. And with that, on that cheery, sunny note, overtime is out of time. Thank you, everybody. Don't go anywhere. Tasty Live at Night comes at you next. That starts with me and macro money. We're going to talk about all of the various macro data points this week that should have your attention. For Dylan Radigan, undisclosed on the continent, and me in San Francisco. We'll see you tomorrow. Happy trading. Is it finally the day of reckoning for these financial markets after so many years of resilience? After the pandemic, after a rate hike cycle of blistering speed from the Federal Reserve, and all manner of other would-be headwinds that were so briskly shrugged off by global financial markets. That's what we are going to be asking ourselves here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And where last week the macro calendar was relatively tepid, this week we have every which bit of event risk you could imagine. And the markets are not taking to it kindly. Needless to say, the week starting with quite a lot of fire and fury here. Weakness spread across all of the major indexes, and markets plainly in a defensive mood. Let's take a look at how this compares with what we saw last week and what stage that sets going forward as we look at this week and what we might be in for next. And the performance that we see for last week is, for lack of a better term, a sea of red. We can very clearly discern here S&P 500 down again, 1.1% for last week. NASDAQ, though, the site of increasingly aggressive selling, down 3.5%. It actually picked up steam to the downside last week. And we can see signs of aggressive liquidation, and that this was perhaps not just a stocks sell-off within a broader rise as we look at what happens with yields and the yield curve. Notice here the 2 and 10-year rates, both down by close to 5%. That is not just telling you that maybe the Fed needs to do more now, or maybe the Fed is going to have to do more later, the kind of trade-off we've seen in recent months around U.S. economic data being a little bit warmer or a little bit cooler, where the markets think, oh, well, the Fed is going to cut later, but they'll do more, or cut sooner, but maybe do less, and shifting a few basis points around here and there along a 2-year timeline. No, this is a concerted drop in interest rates across the curve, suggesting the markets expect the Fed will need to do much more to support growth both now and later, implying some kind of an economic downturn is already underway. As if to highlight that point, crude oil also down for a second consecutive week. Gold down 3.6% despite the situation in yield. Typically, gold as a 9-yielding asset tends to take heart in interest rates falling, because when that happens, the opportunity cost to owning gold improves. But not last week. It seems like the markets wanted to sell everything that wasn't nailed down and go to cash and bonds. Currencies down across the board. Even the yen, which tends to benefit from lower interest rates, much like gold does, it was down. Euro was down. To really put the cherry on the risk-off Sunday here, Bitcoin down almost 11%. So just an absolute liquidation last week with really just cash and bonds, so cash and cash equivalents, seeing any kind of support. And that, of course, speaking to a market is panicked. Source of the panic? The threat of global recession. We've talked about this extensively last week and went through a bit of a series talking about first why a week back from last Friday, those U.S. PMI numbers that we saw that suddenly showed the U.S. service sector shrinking for the first time in 25 months. Why that was such a chill for markets. Saw that, but for the U.S. service sector, the second half of last year was marked by slowing growth. The U.S. economy outperformed, but everywhere else, especially the key engines of global demand, the Eurozone and China, weakened and remain weak. So if in fact the U.S. service sector is weakening, and with it the U.S. economy is starting to turn lower, then the global economy is operating with no safety net and is in the process of losing the one pillar of growth it still has left. Not surprisingly, the markets didn't like it and painted the tape as red as it can be. This week, we're going to get updates on the whole lot of that story with macro data to gauge just how afraid we need to be. And it begins in China with the annual National People's Congress. This is a gathering of China's broad electorate. Obviously, we know the Politburo, a set of 24 policymakers, including Xi Jinping, are really running the show. The NPC, the National People's Congress, is a kind of annual gathering of all of the governing apparatus, including the municipal authorities, to make it official and stamp it and announce that indeed these decisions will be the ones approved to go forward. A kind of rubber stamping exercise, if you will, considering how powerful Xi Jinping is individually and the Politburo is as a group with him at its head, and how influential they are over the entire apparatus. And of course, the issue here continues to be that China is stuck without demand. For 7 consecutive quarters now, we can see that nominal GDP growth has fallen short of real GDP growth. Here's that spread looking negative, and that's not what you want to see. Because when nominal GDP, that is growth plus inflation, is going slower than real GDP, growth not including inflation, then the inflation component is negative. And what that means is effectively the entire economy is in the bargain bin. When there is strong demand, prices go up because would-be consumers of all things compete, and that bids up the price as more people want that which is available at any given time, be it capital or goods or at the consumer level, any which thing. This is the opposite. This is an economy-wide discounting, wholesale, of the total value of goods and services produced in China. And that kind of discounting typically coincides with there not being demand, there not being uptake, and the need to try to generate that uptake with lower prices. Now, China has tried every which kind of monetary stimulus to boost the situation. They've cut interest rates. They've lowered bank reserve requirements to make more cash available. They've spent outright money on boosting the stock market. They've improved lending terms for borrowers that want to be buyers of homes and for municipal governments wanting to cover debts and resume infrastructure spending. None of it seems to have helped. If we look at this Bloomberg index measuring the share of new loans in GDP, not only is it falling and hovering at some of the lowest levels since before the pandemic, it is shrinking, in the yellow bars here is the year-on-year rate, at seemingly an accelerating speed. And so credit growth is hardly supportive here. And so people will be watching this National People's Congress very closely. They expect that the deficit target will be increased. That is to say, China will give itself more room to borrow and spend. And they expect to hear a strong commitment to reviving the economy. China's 5-year plan runs out this year. The next one is from 2026 to 2030. They're going to want to hear that there's going to be a greater cultivation of homegrown tech, a greater focus on economic expansion, less browbeating of industry. And if they're not going to get clear signals that China is getting serious, not only about kickstarting growth with fiscal largesse, but keeping that growth sustained by taking a soft touch on the regulatory side and with industry more generally, well, then hopes for China to be an offset in a global recession scenario are not going to get any meaningful lift. Then, of course, we're back on square one with our global recession fears. Next comes the European Central Bank. They're expected very much to cut interest rates by another 25 basis points. As we can see here, all the way baked in that move in the March benchmark ESTR futures, and further easing on the menu through the rest of this year. In fact, we can see between October, December, January, and now, the overall thrust of Eurozone policy expectations has only marginally changed. The pathway for what the ECB is likely to do seems pretty well anchored for the markets. If we look at what that boils down to, it's 82 basis points in rate cuts this year, followed by standstill next year. So that's 3 cuts this year with about a 24% chance of a fourth. That it's this anchor